charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
We just now need to stay the course. We said we're going to do this. We need to follow through and validate the expectations that we set in markets. Until I see some evidence that underlying inflation has solidly peaked and is hopefully headed back down, I'm not ready to declare a pause. I think we're quite a ways away from a pause.
Neil Kashkari, the Minneapolis Fed president, making his message loud and clear repeatedly yesterday. I think he spoke twice, didn't he, Lisa?
Yes, I think so.
Okay, I think we'll hear from him again before the next Fed decision, no doubt. Live from New York City this morning. Good morning. Payroll's just around the corner. 255 is the median estimate. Jefferies at 350, a whole bunch of banks at 300K, then another group at around 250,000. Goldman Sachs down at the bottom, down near the bottom at 200,000. Yields are higher by about a basis point, 383.88. Equities going nowhere. On the S&P 500, Lisa, pretty much dead flat, unchanged on everything with the exception of crude, and we've had a big rally through the last 4 or 5 days.
People don't understand just what the decline in demand actually is going to be versus the decline in production. And I think that's a big question mark versus some response from the White House. I mean, this sort of sea of uncertainty is the reason why David Balin, not just in the crude market, but just more broadly, there's not a lot of conviction out there.
What do you think the next giveaway from the White House will be if this is a bad jobs report? So, you know, OPEC Plus doesn't go well, and then they come out with a big announcement on legalizing marijuana.
You know, this is for you. You can elaborate. What do you think?
I'm not going to tell you what I think. That's for Anne-Marie. She's going to join us a little bit later. Anna Wong joins us now.
What's next?
Chief US economist for Bloomberg. Anna, fantastic to have you with us in studio. Bloomberg Economics has a really big call for next year. You think Fed funds is going to go to about 5. I think that's about something like 40 basis points above market pricing right now. What separates you from everyone else? Why do you think we can achieve that 5% Fed funds rate?
Well, we have been holding that position since July. We were the first on Wall Street to make that call. And the reason why was because we perceived a change in the reaction function of the Federal Reserve, that I suspect that their the U star is higher than 4%. So the U star is the NAIRU, basically. And I, based on the dot plot, I see that it's actually they think that it's about 4.4% right now. And I still think that that's a pretty optimistic assumption based on job matching data and you know, how difficult it is to hire based on, you know, what we heard from surveys. It just sounds like the U star is more likely to be in the range of 4.5 to 5%, which would mean that if you plug that number into any standard policy reaction function, that would imply a Fed funds rate 5 or higher, actually.
The pushback we get, and I'm sure it's the pushback you get too, is that's unachievable. You will find out you're going to experience financial stability concerns long before you get there. How do you answer that one?
Yeah, so as Governor Waller said very clearly, monetary policy tools are not designed for financial stability management. So the Fed has put out lots of report on that. The more appropriate tools is actually macroprudential and microprudential you know, policies, such as, you know, tightening the bank capital regulations. And monetary policy really is designed for stabilizing macroeconomic outcome. And to think that they would lower interest rate or just pause to preempt a financial risk that they're not sure will happen at the expense of perhaps higher inflation, to them, it's a very costly bet.
So that said, there are probably a number of studies being done by the Federal Reserve and by a number of others about how high rates could go before it does present a problem to the trillions of dollars of debt that have been issued during a time of incredibly low interest rates. Do you have some estimate of where things get a little problematic, considering the debt profile and the interest rates that people have currently, and where they would have to refinance at?
Right, I think so. That sort of test would be, you know, done in the supervision section, which would be running some stress test. But I don't think that's a primary concern for the FOMC committee, just because, you know, to be frank, raising rates to this level will break some things. There will be an increase in defaults. I mean, in 1994, Mexico went into default because of the Fed's raising rates. That will happen, and they will. But their eyes are laser focused on inflation.
How is this time different than in previous decades? Because the fiscal response is not possible in the same way that it has been in the past.
Right.
There is the inability to borrow at the cheap rates that people have gotten accustomed to, and we're already seeing that pushback in Europe. We're already seeing that pushback in England. How much does that factor into your expectation of growth over the longer term?
Yeah, I think what market has underpriced right now is the depth of this recession. I think that given that the fiscal response, as you said, is limited because we are already at a very high trajectory of fiscal debt given our pandemic response, this recession could last longer, not only because the Fed decided not to ease, but also because there's not much counter-cyclical fiscal policy to have. But although I will say that one silver lining on the fiscal front is the state and local government. And Powell actually said this during the press conference, that there's still a lot of buffer at the state and local government level. I mean, the pandemic stimulus provided about $1 trillion of dollars to state and local government, and their coffers have been swelling with revenues due to higher property, higher tax revenues from capital income gains over the last 2 years. So they actually have been given checks. I mean, I live in Virginia. I just got a $500 check. People who live in California.
Do I need to move to Virginia?
I was wondering, why are we not getting free money?
We're still getting checks.
I mean, for what?
Just because they have a lot of money in the coffer, and California people are getting $1,000 check, and they're not the only states. Like Connecticut, they're giving out gas holiday of OPEC drive oil price up to $100. I'm pretty sure, given the fiscal buffers of the state and local government, we are going to see gas holidays provided by states.
This sounded super bearish until the end. Thank you, Anna. This is what it's come down to, hasn't it? There's a couple of conversations going on here. We've had the soft landing versus hard landing conversation a million times. The other one is they will break something, they won't break something, they'll risk breaking something, they won't even go there. And that separates the bulls and the bears right now in this equity market too.
And what Anna is saying is that inflation is very real. The potential for breaking something isn't real enough to really scare them away from doing this. And that's what's being reiterated from Fed official after Fed official. So at what point does the market understand that and reprice accordingly, right? So when does the next question go to the Mike Wilson issue of what should it look like if you discount any potential for removing some of the hawkishness simply because of the possibility of something breaking?
And number one difficulty, Anna touched on it, where does the counter-cyclical circuit breaker come from for the equity market bulls in a way that we saw it play out in the pandemic and pretty much every other crisis over the last several decades? Where does it come from?
We just heard from state and local governments giving you a $500 check and giving you, a $1,000 gas holiday. I mean, how much is this really going to be the future until it runs out?
Doesn't that make you more concerned about inflation?
Completely.
Not less?
Well, I mean, this shows the whole issue with the United Kingdom and their plan.
Counter to what the central bank wants to achieve.
Right, that basically the UK coming out with a plan to cap energy costs with no discussion of capping demand. This becomes the problem.
That's the politics, right? That's the politics. And that's why policy at the moment in a lot of places is increasingly in conflict. Priya Misra is going to join us shortly from TD. Looking forward to that. Just an absolutely brilliant call from her earlier this year on yield curve inversion. Your yields right now up 2 basis points on a 10-year, 384.49. Your jobs report just around the corner on Payrolls Friday. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
For a young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
The market has been on a super high over the last few days.
We've seen volatility across all asset markets.
We might see some downturn dynamics driven by monetary policy.
We're going to look at a higher for longer story, not necessarily a scenario where central banks are entertaining cuts next year.
The Fed's really going to struggle to convince markets that it needs to do a total 125 basis points in those last 2 meetings of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Payrolls 90 minutes away, live from New York City this morning. Good morning for our audience worldwide on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg Surveillance, your payrolls report. Not too far away, Lisa. We're looking for 255K.
And what difference will it make? I mean, I'm sorry to sound existential.
Sure, no, I'm with you.
But in all honesty, how big do the numbers have to really be to really change the narrative on Wall Street, which is that the Fed is going to go hard, that this economy is doing okay, that there is signs of slowing, but it's not enough to really cause some sort of a circuit breaker for the Federal Reserve.
Changes the story going into the weekend, whatever the number might be, and then it gets hijacked by CPI next week. It's all about inflation. They're saying to us, they're looking at the totality of the data. I've said this repeatedly, and you've said it too. There's one number that's a little bit bigger than all the rest. It's inflation. That's the one that matters.
And that's what they're targeting more aggressively than anything else. They keep repeating it. They are willing to accept weakening in the jobs market. They're willing to accept a weakening in many other metrics in order to get that inflation down. Remember when we cared about University of Michigan sentiment survey?
For 5 minutes for one print.
And then it went away. And then we cared about JOLTS, perhaps for 5 minutes. And then that's going to go away. And then CPI will come out and we'll care about that. But people will be looking at core. How are they data dependent if the data is shifting in terms of its importance, really a real-time read on this economy?
Answered your own question, didn't you? They just make it up as they go along. One week is this data point, the next meeting is another data point. Inflation's still running at 8%. I mean, come on, it gets ridiculous sometimes. We're going to look at the participation rate in the jobs report a little bit later this morning. If that starts to rise, get excited about a supply-side solution maybe. Inflation's still at 8%. Can they back off with CPI with an 8 handle? Can they really?
Well, they can't, right? But David Balin was really highlighting this issue that you see in markets, which is people believe that the Fed will raise rates significantly, but they don't believe they will have to hold them there for that long. Even as the Fed comes out and says, yes, we will. Yes, we will. Yeah, no, we really will. And everyone says, no. And we're seeing that consistently in the pricing. And at what point does the Fed have the credibility to actually go through with what they're saying to actually convince markets to move in that direction?
A word on Governor Waller yesterday afternoon. What do you make of that?
Basically, he went through point by point every argument for the bulls and just said, you're wrong.
Cold water.
Cold
Freezing.
water. Freezing. Just basically, if you're worried about financial stability and you think that we're going to pause rate hikes because of financial stability concerns, you're wrong. That's basically what he said. He went through each argument and just absolutely tried to dash it. And at what point can it get more clear than that?
You know what the bulls were saying back? No, you're wrong. You're wrong. And that's the conversation right now, right? It's not just soft landing versus hard landing in the economy. It's about whether they respond to financial instability risk or not.
Do you think that the Federal Reserve has really regained credibility, given that we're having this discussion with the market challenging its premise?
The amount they're talking, the idea that they're all on the same page, I think they don't think themselves they've regained that credibility yet, which speaks to why they're all singing from the same hymn sheet repeatedly. And you saw that from Kashgari yesterday. And to your point, for Governor Waller to go through point by point by point, everything equity bulls would like to see and just push back, I think that tells you everything you need to know.
They're listening to markets and they're saying, you guys are wrong. We have conviction. We're on the same page. And I think you said it really well, which is the fact that they're all speaking and speaking twice a day, 3 times a day to say the same thing, to go through each point that's being talked about in markets says quite a bit.
You know what the bulls and bears all agree on? They just want that to stop.
I think you're right about that.
They really do. Here's the price action this Friday morning. Good morning to you. We shape up as follows in the equity market going into payrolls. Looking for something in and around 255K according to our survey. That's the median estimate so far. Futures unchanged on the S&P. Yields up just a little bit, up by a couple of basis points. 384.49 on a US 10-year. And euro dollar not doing much at 97.97. I tell you something that's done a lot this week. It's crude up another 1 percentage point. WTI, Lisa, 89.37.
What a muddle there. I just want to offer you this. Chris Webb on Twitter says that we still do care about University of Michigan sentiment because of the vibes. So there are some people who still care. 8:30 a.m. We get the September U.S. non-farm payrolls report. The high number from J.P. Morgan Asset Management's David Kelly, 389,000. The low of 199,000. How much will actually make a difference at a time when average hourly earnings are still rising at an estimated 5% year over year, marginally much more in certain areas. And frankly, as every single Fed official comes out and says, you know what, we are going to continue raising rates. Even if something breaks, we will hold them there. Today, we also hear from the administration on what the response is to the labor market report. Labor Secretary Marty Walsh on with our very own Jonathan Farrow on Bloomberg Television at 9:40 a.m. And President Biden speaking later in the day. How do they spin this, right? I mean, how do they talk about a good labor market as a positive thing when you have a Federal Reserve pushing back and saying, actually, this is a problem based on where we need inflation to be, and we cannot have a stable labor market given that inflation is above 8 or 9%. And we'll get the spin because we do have a daily Fed show, and that Fed show today consists of New York Fed President John Williams, Minneapolis Fed President Neil Kashkari, again, Atlanta Fed President Raphael Bostic, again. How many times do they have to come out, John, and really just reiterate, we're going to stay the course. And if you guys are pushing back, that's going to be on you when you get, basically your face ripped off.
What are the vibes? What does that mean? The vibes.
How are you feeling?
How are you feeling?
How are you feeling today?
Like the vibes of the economy?
Yeah. Like just,
okay.
How's it going?
That's very sensitive, isn't it?
Anytime.
Feelings.
Yeah.
Feelings. Tom would sing.
I have no doubt. I was having my head.
What is he? He sings a song about feelings.
Yeah,
anyway, I don't know what that is.
Yeah.
All right. Priya Misra joins us now to talk about the vibes of the bond market. From TD Securities. Priya, great to catch up. We keep celebrating your wonderful call on yield curve inversion. You said -40, maybe -50, long before we got anywhere near those kind of levels. Right now, 2s, 10s, -43. Priya, you've got the crystal ball. What's driving this?
I don't have the crystal ball. There's still a lot of uncertainty out there. But the reason for that inversion, which I have to say our payroll forecast sort of argues for more inversion or the inversion persisting, is this idea that the economy responds to a lag or with a lag to higher interest rates. And the labor market's still tight. So we're looking for a 300,000 payroll, so another strong report. It's going to keep the Fed very much on their mission that they're going to continue to raise rates. You know, I think the front end is pretty fairly priced. We're looking for 5% terminal. The market's priced for 4.6. I mean, between 4.6 or 5. What's 40 basis points among friends? So that's largely, I think, well priced. It's the long end. I think what's happened is as the markets reprice the front end, it's also taken long end rates higher. And that's what I struggle with. I think the Fed's forecast of 4.4 on the unemployment rate by the end of next year looks very, very optimistic. I think if they're going to tighten, and they're all telling us, all of them, that they're going to tighten, they've also got QT tightening, that's going to start to slow things down significantly. And they may want to keep rates on hold higher for longer. But if the economy slows down meaningfully at some point, and this is what I'll stress, maybe it's not the end of 23, maybe it's a 24 story, but the 10 years pricing in a view over a long time, the Fed's going to have to cut a lot more than what's priced in because they'll need to take rates into accommodative territory. We're talking well into the future, but that's what the 10 year is pricing in. So I think that 10 year, it feels unsustainable at 4%. So, it's not so much now a front end call. My flattener call is much more that the long end is going to rally because we're going to see growth slowing and we're going to hear from a pretty tone deaf Fed that they're going to continue to raise rates.
Priya, that's exactly where I wanted to go. You called the Fed tone deaf. How is the Fed being tone deaf right now?
Well, I should clarify. They're not being tone deaf on inflation. I think they've recognized that there's an inflation problem. It's much too high. They want to keep expectations anchored. Where they are tone deaf is the tightening in financial conditions and the slowing in the economy. I actually think it's the intended consequence of tightening. Where they're going to sound tone deaf is as the economy slows down, and we're used to a Fed that responds. We're used to, remember the preemptive cuts in 2019, where things started to slow down and the Fed said, you know what, let's cut a few times to be preemptive. I think the inflation picture just reduces that policy space for the Fed to sound preemptive at all. In fact, I'm going to argue they're going to be late. They're going to want the data to tell them to start to cut, and the data is going to slow down slowly because a lot of the data that they're looking at, CPI, labor market, these are highly lagging indicators. So by the time they slow down, we'll be well into a recession, which is why I think they'll have to cut more. But they are going to be tone deaf to slowing in the economy, which the equity market's going to keep tantruming about.
You said something that I really want to pick up on about the 10-year Treasury yield going much lower in the future, and people are discounting how much the Fed's going to have to lower rates when we do get that kind of downturn. What seems fair value? How do you push back against people who say we are entering a higher inflationary regime with a Fed that cannot afford to be as accommodative as it was over the past few decades?
Sure. So I would separate that 10-year into real rates and inflation expectations. Now, if you believe, and we're sort of in that camp, that inflation will come down. There's base effects next year. Commodity prices are already lower, notwithstanding what OPEC did. But, if inflation gets down to, say, 3% by the end of next year or 2024, then it's really a question of real rates. Can the economy handle higher real rates? And there is this narrative building that we are entering some new normal, or maybe we're going back to the old normal, that the economy can handle higher interest rates. I know leverage is not as much of an issue, but I don't think productivity or the potential output for the economy or potential growth is that much higher. I don't think we can handle much higher real rates. So 10-year real rates well north of 1%, that's going to slow the interest-sensitive sectors first. That's going to spill out further. So, if you're nervous about inflation or you think inflation might stay high for longer, buy those real rates, because I think the economy's ability to withstand higher real rates has not changed. I think there's a lot of evidence that our star or real equilibrium real rates is lower. And so maybe, you can decompose your view on the 10-year and just have more faith in that real rate component, which is where we come out, that those real rates are much too high. They won't be able to be sustained for that long.
Priya, I've got 20 seconds, just some very, very quick, short, snappy scenario analysis. Yields up, yields down. If we get a big upside surprise, 400K, can you tell me if it's yields up, yields down, and the same with 100K a little bit later? How does this play out in the bond market?
Well, it depends on which yields. I think if it's front end, absolutely higher, because the Fed's going to keep going. They're not stopping. The long end, I think, will also move higher, but that's what I would look to, start to go long. 100K, I think, it should be lower rates, but further out the curve, because the Fed's telling you that 100K is not going to deter them from going 125 this year in terms of hikes or continuing hikes next year. So I think it's which part of the curve, but 100K is certainly bullish for that long end. And really, I would say equities is negative in either scenario, because it's either you have a hawkish Fed or a slowing economy.
It sounds like you're buying tens in either scenario too, ultimately. Priya, wonderful to catch up. Thank you. Priya Misra of TD. Your jobs report, isn't too far away, 8:30 Eastern Time. Well, before we get there, we'll catch up with Ellen Zentner of Morgan Stanley, and we'll catch up with Nadia Lovell of UBS. Looking forward to it. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden is worried that Vladimir Putin's threats to use tactical nuclear weapons are real and could lead to, quote, Armageddon. At a fundraiser in New York, the president said the U.S. is trying to figure out the Russian leader's off-ramp. Putin renewed his nuclear threats when he announced the annexation of territory in Ukraine. The Nobel Peace Prize has been awarded to human rights activists from Ukraine, Russia, and Belarus. They were cited for documenting war crimes, human rights abuses, and abuse of power. At the same time, the chair of the Nobel Committee criticized Vladimir Putin and the government in Belarus for suppressing activists. Investors and the Fed will be watching today's monthly U.S. jobs report closely. It's forecast to show that employers added 255,000 jobs in September. Now, that would be the smallest number since a decline in late 2020. Still, it would be an indication that the labor market remains strong. The report comes out at 8:30 New York time. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
August jobs were right on target.
Pretty much in line with what Wall Street expected.
A Goldilocks jobs report.
Today, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Does this imply that central banks will blink?
They want to see a little bit more slack in this labor market.
I don't think the Fed wants to see unhappy people.
There is a lot of monetary contraction and austerity coming down the pipe.
The September jobs report, today on Bloomberg Television and Radio.
To me, according to our reports, headed for 4.5 to 4.75% by sometime next year, which, given how fast we've been raising interest rates, is likely to be the springtime.
Charles Evans of the Chicago Fed. All of the doves sounding very, very hawkish. Can you make sense of this, Lisa?
You know, I keep going back to...
Kashkari, Evans, take your pick.
And they're the most hawkish among the group. And we have James Bullard, who might end up being dovish later on because he doesn't necessarily see the need to continue hiking rates as dramatically. How much, though, does this really highlight that the pain is being felt by inflation and what that's doing to household budgets, not by the potential unemployment and not by the potential weakness in an economy that has not yet been realized?
Next up for this discussion, payrolls, 1 hour and 12 minutes away. From New York City this morning, good morning. The price action going into payroll shaping up as follows in the equity market on the S&P 500. Futures right now, just unchanged, going absolutely nowhere. Yields are higher by about a basis point or so on a 10-year to 383.67. Euro dollar not doing much. 98 on euro dollar. Tell you what's doing something, crude, 89.28, positive 1 full percentage point. Before today, we were already rallying hard. WTI through Thursday up around 12 percentage points. What do we call the SPI yesterday? The Strategic Midterm Reserve?
Yeah, and we got a little bit of pushback. I got a little bit of pushback.
Did you?
People, yeah, people saying that this is an appropriate use because it's helping to support the financial stability of a nation that's going through a volatile time. And I can see the skepticism in your furrowed brow. And I do wonder whether that is echoed by other people or whether they don't care.
Is this a skeptical face?
No, it's just like when you're going like this.
Come on.
Come on.
So I asked Francisco Blanch of Bank of America about this, about the unintended negative consequences that come from the politicization of SPR. Take a listen to this.
We have had no oil crisis yet. And the key word here is yet. If you lose your ability to temper price appreciation, because there is an actual physical disruption of molecules in crude oil, you're going to wish you had those barrels in store. That's, I think, a big problem releasing the SPR right now.
Team coverage starts right now with Maria Tadeo in Prague and Anne-Marie Hordern in Washington, D.C. AMH's day 2 of OPEC Plus fallout. What's the latest?
Well, latest is that, Jonathan, what you're hearing on Capitol Hill is more of this idea, at least from lawmakers, even though they're back campaigning for the midterms. What they are talking about is Saudi Arabia, and they're talking about NOPEC, this idea and this legislation that for really 20 years has kicked around, but no president would really ever sign this, right? Because the repercussions. And this would basically give the Justice Department the leeway to go out and sue some of these countries a part of OPEC. Now, right now, even though this is potentially just an idea, you have Senator Chuck Grassley saying that he wants to put it as an amendment to the defense spending bill. His inbox yesterday, what I got from him, was my bipartisan NOPEC Act would crack down on these tactics by the foreign oil cartel. And what's interesting is I asked Amos Hochstein, Biden's top energy advisor, about this. That statement from Jake Sullivan and Brian Deese, was this a nod to NOPEC? And he said, I'll let you read the tea leaves. So the administration is definitely sending a warning shot. And we should say that even just the mention of NOPEC, this would give some Gulf officials nightmares.
Although they're kind of pushing back, and Maria, I'd love you to weigh in on this. We heard from them that the oil price caps for Russia that Europe is currently talking about was part of the reason for their wanting to cut production because of the extra insecurity, the extra uncertainty introduced by this. Do you understand what these price caps are and how they're factoring into this political decision?
Well, I think a lot of people are still trying to understand exactly how the... Oh, go for it, Maria.
Take it up.
Go for it, Anne-Marie.
All right, well, I'll quickly say my thoughts on the price cap, and I'll hand it over to Maria, because obviously this is a huge issue for Europe. U.S. officials want this to happen, but it's the Europeans that are really going to have to be the ones to implement it, because they're the ones that have sanctioned that Russian oil, and also it's the Greeks and the Cypriots who really have the transactions for this in terms of the shipbuildings. But from the OPEC side, what they don't like, a lot of producers, is the fact that they think this would set a very bad precedent. The fact that the United States could decide what a producer is selling their oil at.
Maria, what's your view?
Well, I would say it's day 2 of a summit. It is 1:30 by my standards. In 30 minutes, it's time to break up for lunch. And European leaders are still locked up in a room trying to figure out what they want to do with energy prices. Now, to me, what is striking is that I've heard nothing here. This is not a conversation, the oil at all. And again, this goes back to the fundamental issue. This is something that is incredibly political. It's domestic agenda in the U.S., but when you look at the domestic agenda for the Europeans, their focus at this point, I would say almost exclusively is on gas. They're still debating this price cap. Again, I can tell you there's 5 different options on the table. That is part of the problem. They can't agree on a solution because they still haven't figured out which of the options could actually fly. The other thing today that is being debated, and this is potentially new, is the European Union saying perhaps we should revisit some of the tactics that we used in the pandemic. That means that we buy gas as one single unit, so you don't have European countries that essentially go out on the market and outbid each other. Now, this was something that the French president floated. He said perhaps it could be a good idea. Now we buy not as individuals, but as the EU. The question is, however, who decides who gets what? And if you're Germany, what you care about is having a lot of reserves this winter.
The two of you, so polite to each other. Maria Tadeo in Prague, AMH down in DC. You see that? Just refuse to step on each other.
Well, yeah, you know, some people...
Bloomberg surveillance.
Yeah, I was about to say.
It's the home of cutting people off.
Yeah, I was going to say, when do we get to another level? But this is one reason why, too, some of the Zoom communication and the delays were really problematic during the pandemic. I will just say, because you start talking and then it's like this awkward, well, do you let the other person go?
I get it.
Come on, wasn't this like one of the big sort of banes of
doing
pandemic?
TV from home and radio.
It was brutal, right?
Drive me insane.
So I give them credit, because it's not easy.
There were moments where everything would go silent, and I had no idea if we were in commercial break or not. So I would just stare down the barrel of the camera and talk for 5 minutes on my own.
My children would be eating breakfast on the couch,
right,
and they would be really quiet, but they would, be kind of creeping over to the sink, and I'd just be like, "Oh, come on, monetary
let's
policy."
not reminisce about that time. All right, payroll's an hour away. We're looking for 255K. Throughout the whole pandemic in the last couple of years, the range has been so wide, and all of a sudden it's really, really tight. And I wonder what that tells you.
I mean, honestly, maybe it's that nobody really wants to take a real big, wild guess. Maybe it's just because things are chugging along. And when do we hit that precipice where we see a real shift that really changes the discussion, where we start to care a little bit more about jobs report? Because it is important, but it's not really going to move the needle today.
Which one's the high? JP Morgan Asset Management.
Yep, David Kelly. 389.
Goldman near the low at about 200K. The jobs number, 60 minutes away. We'll catch up with Alan Zentner and Morgan Stanley as well in just a moment. Looking forward to that. In studio here in New York, live from New York, this is Bloomberg.
lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Live from New York City on TV and radio, this is Bloomberg Surveillance for our audience worldwide. 1 hour away from the payrolls report. The price action shaping up as follows on the S&P and on the NASDAQ too. Futures going absolutely nowhere on the S&P 500. The NASDAQ 100 down about 0.33%. The S&P through Thursday up around about 4.43% on the week so far, driven by what's happened in energy. The energy names on the S&P 500 as a group up 15% in the previous 4 days. Brent and crude shaping up as follows. WTI through Thursday up around 12 percentage points, and we add to the gains this morning, up by more than 1% on WTI crude at 89.47, on Brent crude 95.42, up by a little more than 1%. So that's the connection between the commodity market and equities this morning and through the week. Let's talk about the bond market too. The 10-year coming very close to grinding out another weekly gain on the yield for a 10th consecutive week. Yields higher by 2 basis points on a 10-year. Right now, Lisa, at about 384.49.
And the move in real yields, really, we cannot overstate how significant that is. And Priya was talking about how that really does shift some of the expectations for risk asset pricing based just on that and how sustainable that is. I want to take a look at a couple single names, in particular in the semiconductor space, because AMD reported earnings last night, and they actually said that their third quarter sales projections missed expectations by more than $1 billion. They said that things are moving very quickly. Those shares are down more than 5% in pre-market trading, but this echoes what we've heard from Samsung. This echoes what we've heard from Intel and NVIDIA, and all of those shares down very sharply year to date. If you take a look, you're seeing more than 50% declines for AMD, and for NVIDIA, Intel shares down nearly that much. John, you wonder at what point this is a signal for something broader than just, a rapidly shifting cycle where people were buying personal devices, they built up inventories, and now they're not seeing the same orders, right? Is it that kind of stop and go in that specific sector, or is this a broader statement that's going to hit Apple, that's going to hit the other big tech names in a fundamental way, aside from just valuation, because of real yields, because of some of the changes in monetary policy?
Our reporting around Apple in the last week suggesting there's a bit of a demand issue. The demand is faltering with the iPhone. Chris Harvey of Wells Fargo, remember the original Chris call, which is wait for the weakness that will come the first half of 2023. He's saying in the earnings it's going to come much, much quicker now, and his views changed in the last couple of weeks.
And if AMD, if Samsung, if Intel, if all of these chip makers are any indication of a broader economic slowdown, particularly in the chip sector, particularly in some of the electronic devices that people bought feverishly during the pandemic, then this is setting a pretty bearish signal.
Will we see some of that data in the labour market? I'm pleased to say that joining us around the table, Ellen Zentner, the chief US economist of Morgan Stanley. Ellen, good morning. Great to have you with us.
Good morning.
Went through the preview note, went through a couple of the numbers. And again, I said this to Sarah House of Wells Fargo. It's interesting. A lot of you are highlighting what you expect in participation. Yeah. How important is that going to be in 60 minutes' time?
It's really important. I think headline is what markets are going to be focused on here because the Fed needs to see substantial slowdown in job gains. But participation from a medium-term standpoint, we need to see more flows back into the labor market. And immediately we look at prime age labor force participation. So you strip out those that are less than 25 years old, you strip out those that are older than 54 years old, and we call that the prime age participation. We want to see those flows continue to come back into the labor market because regardless of how many job gains you've got, that's what's going to help you take pressure off of wages. And that's been a problem for the Fed when inflation is that high.
That's the ultimate bullish solution for people in this equity market, that we get this positive evolution on the supply side. What do you think the job openings, what do you think the message is from the job openings decline that we got earlier this week when it comes to the story of getting a supply side response?
Yeah, so I think of job openings as missed. right? So what we've been hearing from companies since the summer, and this comes from our equity analysts, we do these department huddles with our equity analysts, and companies have been telling us, look, we hired the need to fill positions. We've had these nice to have positions that have just been open for a long time, and we've not been able to fill them, so guess what? They're gonna go away, into the mist. Right? And that's the drop in job openings that we're seeing now. Now that typically leads slower hiring or slower payroll gains. So that's actually encouraging to us that we are going to be right and you're going to see a more substantial slowdown in job gains. It sounds terrible. Economists are the worst, right? We get so excited at bad data. But that's what the Fed needs to see for them to be comfortable that they're really dinging the real economy.
The fact that we haven't seen worse data, talking about sort of the perverse inclination right now of economists that want to see inflation slow, the fact that we have not seen that weakening, how far away are we from the possibility of soft landing? How much further are we than we were, say, 3 months ago?
Well, it is the case that all year, right, revisions have been going higher for inflation, lower for growth. Inflation has now moved into the very sticky parts of the economy. I think it's going to be very hard to get a substantial slowing in rental prices, which is the biggest component the Fed is concerned with. You've just got to get the unemployment rate higher. And so I think as we're moving into next year, you are going to see more evidence of the trend in inflation softening, right? Not a big drop, but softening at the same time that you've got a real drawdown in these job gains. So that sort of sluggish global economy, sluggish U.S. economy, with the evidence of that, right, would tell you, okay, we can be more certain that this trend is going to continue. That's one reason why, when we talk about the Fed pivot, what does that mean? Right? Does it mean they go from hiking to cutting, hiking to stopping? To me, the first pivot is hiking to slowing those hikes. And I think that's when markets and risk assets really grab onto that message, because that's the beginning of the end of the hiking cycle. As soon as you indicate you're comfortable to even slow the pace, and that's what we're waiting for.
Is it appropriate, though, at that point to really feel bullish on risk assets based on the fact that then you have seen the weakness that will necessarily lead to weaker profits, perhaps a persistently higher unemployment rate if you believe the stickiness that a lot of people speak about once people lose their jobs?
Yeah, so I think this is the biggest debate that economists are having with the strategists, right? Because in one sense, you're saying, okay, I'm really encouraged that we're getting to the end of this hiking cycle. But if you're getting to the end of the hiking cycle because things are really bad, then can that be a real bullish sign? And so you've got to have some signs that the economy is slowing, but isn't going to be disaster, right? And we have GDP growing 0.5% next year. Now, statistically speaking, that's no different than putting a negative sign in front of it. So it is we are walking a knife's edge difference between a soft and a hard landing.
Some banks have a negative sign. Bank of America is one. Mike Gapen caught up with Lisa and I earlier this week, and he told us that he's expecting the first 3 quarters to be negative growth next year. And we asked him if the Federal Reserve would be cutting with that backdrop, and he said no. If they're going to cut, it's going to start at the end. December 23, is that what he said? Something like that. Ellen, do you foresee a scenario that could play out where we get a recession and they don't cut interest rates?
Well, they will cut interest rates, and it will be recession in Gapen's view, right? But the Fed is lagged, right? Because they have to wait for the body of evidence of the data to come in, and it can be quite lagged when you get evidence of negative straight quarters. It all comes down to financial markets at that point. You can be in recession with still high inflation, but our markets in disarray. Is liquidity hampered? Are credit conditions really deteriorating? That then is why the Fed would then need to respond if a recession is coming with that. I mean, think about it. We got negative growth in the first half of this year, and they didn't cut rates, right? So we also have the Fed cutting in December 2023. That's later than the market expects because inflation is still going to be quite high, even with growth as weak as we have it.
What does this mean for longer-term expectations of growth, given that this economy is predicated on rates that are incredibly low, on debt that's been issued at near zero rates or benchmark rates, and that suddenly we're talking about protracted periods of time with north of 4% Fed funds rate? How much slower will growth have to be in the world's biggest economy over the next 5 years?
So I would think of it as separating a cyclical from a longer run view. If you think about longer run dynamics that affect potential growth in the economy, nothing's really changed, right? The demographic backdrop is the same. Productivity metrics are the same and expected to be about the same. And so it's one reason why you don't see the Fed really revise their estimates for longer run potential growth in the economy. Cyclically, though, we've got to digest higher rates than we've had in quite some time. Now, what matters is the shape of the debt that you're carrying. So households are locked in at low fixed rates. 97% of mortgages outstanding today are being held at a 30-year fixed rate, and the effective yield on all of that is about 3.4%. So as the Fed is raising interest rates, the bulk of the household balance sheet, those interest expenses are not changing. For corporates, right, we hit COVID rates 0, and they refied, and so now that wall of debt that was coming due has now been pushed out to about 2028. So you're talking about the next 3-4 years, right? And because of the composition of the balance sheet of households and corporates, it's not as big of a problem as you would think in terms of growth.
It sounds like all roads lead to a higher terminal rate, given everything you've just said. Do we have to push it higher to slow this economy down?
Yeah, well, there's a near-term neutral rate, and you hear the Fed talking about that. Inflation is high, labor market is tight, so they've got to go much further. They don't know how much further, and that's the problem. None of us do, right? Longer run, again, the dynamics haven't really changed, so at some point in a beautiful world, and their forecasts are always in a beautiful world, you start to normalize policy back toward that 2.5% neutral rate that they think the economy should be running at.
Why are their forecasts always in a beautiful world? Why is that?
That's the modeling. The models always look to return you to this beautiful, it's Hellenic beauty in these forecasts, right? And so over time, as they stretch their forecasts on further and further, they're forecasting out to 2025. If any economist tells you they're accurate more than 2 quarters out, they're just lying. I mean, guaranteed you will be wrong. You can get the narrative right, but guarantee you the numbers will be wrong. But the longer you go, right, these models are just going to return you back to this beautiful equilibrium.
The Hellenic beauty of the Federal Reserve.
We need to cut that and play that for the next
over and
show.
over again, every time someone speaks.
Ellen, just awesome to have you in the studio with us.
Thanks, guys. Good
Looking for 250K today, right?
Yeah.
250K from the team at Morgan Stanley. And thank you very much. Your payrolls report not too far away, 8:30 Eastern Time. Steve Englander of Standard Chartered is going to join us shortly. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Less than an hour from now, we'll see if the hot U.S. labor market has started to cool off. Today's jobs report is forecast to show employers added 255,000 workers in September. Now, that would be the fewest in a month since a decline in late 2020. Now, even if that happens, it's not expected to convince the Fed to stop raising interest rates. President Biden has taken his first major steps toward decriminalizing marijuana. The president pardoned thousands of Americans convicted of possession of the drug. Now, he also ordered a review of its legal status. Meanwhile, the president's actions have given marijuana stocks in the U.S. a jolt. They are rising in pre-market. China is showing its clout on the world stage. The United Nations blocked the debate on China's human rights abuses in Xinjiang, just weeks after publishing a report on the matter. The U.S. proposed draft resolution at the UN Human Rights Council was narrowly blocked. China has rejected allegations that it abuses Uyghurs and other Muslims. And it was Bank of America's last remaining legal holdout from the financial crisis. B of A has agreed to settle claims by Ambac Financial regarding residential mortgage-backed securities for more than $1.8 billion. The bank says it expects a pre-tax expense of about $354 million for the third quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
We have tools in place to address any financial stability concerns, and we should not be looking to monetary policy for this purpose. The focus of monetary policy needs to be on one thing: fighting inflation.
Christopher Waller there, the Federal Reserve Governor, pushing back hard, I'd say, Lisa, against those that think this Fed is going to pause over financial stability concerns.
How much do they read the analyst notes on Wall Street and go through point by point and decide, okay, no. I mean, I keep going back to this.
You think that's how that
like.
speech was put together?
I mean, otherwise, what are they responding to? Is it other Fed officials that are saying, what about financial stability concerns? Is it Andrew Bailey coming out and being like, guys, you have to think about this. What happens if your LDI, oh, wait a second, you guys don't have the same kinds of schemes in the US.
The Bank of England started it, right?
Yes, exactly.
They started the conversation in a bigger way. Did you get the note from Steve Englander?
I did.
Transitory disinflation yet again. And when I read that, I had to check the date to make sure that it was actually dated October 6th and not October 6th, 12 months ago.
All these dirty words now. Disinflation, transitory, put together.
Take your pick.
Yeah.
Steve's on right now. Steve Englander of Standard Chartered. Steve, I had to read it twice. Transitory disinflation yet again, really?
Well, what I meant was that, people who are fans of a strong dollar, because they say it leads to disinflation. We've had strong dollars, episodes of very strong dollars before, and unless you think it's going to last forever, the dollar comes back and you give it back. You give back the disinflation. So, to me, it's not a particularly compelling argument. I mean, the backbone of inflation has been goods inflation through most of this period. That's what should have been affected by the dollar. It didn't have that much of an impact. And yet what we're seeing is that the dollar is causing a lot of problems globally in emerging markets and elsewhere. So it was a case to be made that if you think that you're getting benefits from the strong dollar, that this reverse currency war is kind of, playing your way, that you're probably fooling yourself.
Okay, so basically, just to simplify this, strong dollar for longer?
Well, it could be strong for longer. It doesn't mean it's desirable that it be strong for longer. I mean, it obviously depends, on how risk appetite goes. Dollar's been very much propelled by risk aversion, and it depends on rate differentials and how the U.S. economy goes. And that's what we're waiting on at, for payrolls this morning.
We were talking about Chris Waller and really sort of shedding some cold water on this idea that financial stability concerns could cause the Federal Reserve to really back away from any of their rate hiking plans. And I think the strong dollar very much falls into that question, especially as people talk about financial stability concerns outside of the U.S. At what point, based on how much strengthening we've already seen versus major currencies, at what point, from your vantage point, does it really create something of a destabilizing effect on the rest of the world?
Well, I think when you begin to see, CDS blow out, when you begin to see spreads widen, and, from the point of view of the Fed, if you begin to see domestic financial institutions under pressure because there's some exposure abroad that, they weren't aware of and the market wasn't aware of that's beginning to come out, I think it does become material. Saying that you're never going to react to this is like, telling your kid you're never going to, bail him out if he overspends his allowance. There's a point at which you kind of throw in the towel. They don't want to do it clearly, but there is a point at which they will.
Well, Steve, you've nailed it then. It's about signaling something. And there's a difference between what they want to signal and what they'll actually do. Steve, I want to talk about the signal that you would take from a Fed that starts delivering some kind of decelerating rate hikes from 75 to 50 to 25, and they start to lay the groundwork for that, how you think the dollar responds to it?
Well, I think the dollar would fall, and I think, that would be a good thing. I think it would be sensible, even though our forecast is that they do 75 at the next meeting, I think it would be sensible to decelerate to 50 and kind of say, look, 50 is a big chunk. If it turns out that that's not enough, we can add a hike or two in 2023 to, bring things to where we want them to be. But there are enough signs that the economy is slowing down that I don't think you have to have your foot kind of jamming on the brakes at this stage to the same degree that we've had the last couple of meetings.
Steve, within G10, how would you like to position for that? Is it against the Japanese yen? What would you do?
I think the two currencies that have a real chance of appreciating if there's a pivot, one is the yen because it's been super sensitive to rate differentials. And I think an improvement in risk appetite, everybody hates the commodity currencies now. Aussie is really, really cheap. I think that there's some room there for it to, under 65, there's room there for it to pick up on any kind of good news. So it's kind of a barbell view.
Steve, just on the Aussie, is that a commodity story for you or the fact the RBA is backing away? What matters more?
I think it's a risk appetite story. Everybody is so down on where activity is going and where risk appetite is going, and it's playing out, not particularly through the commodity side, but it's just the beta that Aussie has.
How difficult is it to go long the yen proactively in case there is some sort of shift from the Federal Reserve?
Well, actually, I don't think it's that hard. We put out a piece earlier this week arguing that the Japanese intervention had been reasonably successful, not a home run, but maybe a ground rule double or something. They spent $20 billion, and for a week or two without doing anything, you could see material impact in terms of the way the yen was trading, even when other currencies were selling off. So I think that if they can successfully impose a ceiling, and if they were more aggressive, and if they gave some hints that they were eventually going to back out of yield curve control, I think they'd be very successful in strengthening the yen.
Steve, awesome to hear from you, sir. Steve Englander of Standard Chartered. I think we're all waiting to see what happens at the Bank of Japan once Governor Kuroda steps aside, aren't we? Does yield curve control go with him?
There's a theory that that's what they're waiting for. He leaves, he's got what, 6 months, 5 months left?
Something like that.
And that when he leaves, then they'll allow it to go away, but he's not going to let it to go away under his watch because it's basically his flagship program. He did this, and so he's going to keep it in place.
What does the bond market look like? I still wonder what the bond market looks like that morning if they step away from yield curve control.
it cannot be just ripping the Band-Aid off, because the dislocations, at least based on valuations right now, would be so dramatic. When people talk about the yen, they say the bigger problem is in the Japanese bond market that is not a market. It does not trade. It does not have active bids and asks. It doesn't have people who are accustomed to finding market pricing.
I wouldn't necessarily express that in the JGB market, but I'd be itching to do something somewhere else. In sort of highly liquid government bond markets elsewhere, that you'd expect yields to shift a whole lot higher off the back of that decision from Japan.
What I suspect you're referring to is longer-term U.S. Treasury yields, and that is what a lot of people are saying will happen. Actually, that is the bear case for longer-term Treasuries, is if there is some removal of yield curve control in Japan, the ripple effects through the U.S. markets will be significant.
That was Steve Englander of Standard Chartered. They're looking for 250K. Other banks are as well. Just a long list of sort of, they're all tight and packed up around 300K, 250, 200.
Yeah, and you made the point, and it's a good point. I honestly don't know what to make of it, which is the reason why I've had nothing particularly intelligent to say on it. But when you said, why is it that for so long...
I was just wondering.
I have no clue. But,
Such a wide range for ages.
And then now it's a tight range, and I really have no answer. But, people are smart as
Well, it doesn't matter. In about 35 minutes, you get the real deal. The jobs number's going to drop. The median estimate in our survey so far, about 255K. The number's going to drop in about 34 minutes. In just a moment, we'll catch up with Nadia Lovell of UBS. Looking forward to it from New York. This is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
For a young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
What's driving inflation is low pay, low wage, low skill jobs.
They want to see some moderation in the labor market as well as some better inflation numbers.
We got to look at where the situations are fragile and where the higher for longer story could potentially break things.
I certainly think we can live with interest rates being much higher.
If we have some positive surprises, the market's looking for good news, I think it'll react.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Payrolls 30 minutes away, live from New York City this morning for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Counting it down to Payrolls Friday, 30 minutes away. Bramo futures totally unchanged.
So exciting. Everyone's really excited for this data point. It's going to be the most important data point
sarcastic.
Next week.
Until CPI.
Well, no, I think it's going to be important to see how the labor market is progressing. But I think that right now, to understand that this is going to have any determining effect on the Fed's path or the narrative around it is a bit of a stretch. So then where does the marginal trading come from, right? How do we interpret whether this is closer to a soft landing or whether this is closer to the Fed going harder with respect to rate hikes?
So let's take a bank that's had some big calls for big hikes this year. Citi, the team led by Andrew Hollenhorst, they just published a downside surprise to payrolls. That would be 100K or below for him and the team. Following the 1.1 million plunge in job openings would serve as a first sign that tighter financial conditions are gaining traction on the tight labor market.
This speaks to what Bruce Kasman over at JP Morgan was saying, that several months of 100,000 jobs being created consecutively would cause some sort of pause, some sort of reassessment by the Federal Reserve. Will they signal that, though, because they need the markets to remain tight? I mean, really, this is an honest question because they've been coming out and they really have been basically watching the markets and saying, guys, stop with the hope. Just quit it.
If they start to signal that we're going to go from 75 to 50 to 25, you've got a decent idea of how people think this market responds to that. And then we also know at the same time this Fed wants to keep financial conditions tight, tight, tight. It's kind of bizarre, isn't it, that all these Fed speakers are out there basically doing something that Kashkari talked about a few weeks ago and no one's touched since. They're trying to cap financial conditions and make sure that the market doesn't run away.
They are very concerned about inflation. They want all the help that they can get. And what we're grappling with right now is that monetary policy does not have that many levers to push and pull. So the one that they have is making sure that markets appropriately tighten, that it is difficult for you to be able to raise money at the same kind of pace. And so they're going to go at that at the same time that people are wondering whether the labor market is not perhaps the appropriate place to be looking for what's to come.
So you said it. When we get to the CPI report next week, will we even be talking about the data point that drops in 27 minutes' time?
I'm going to go ahead and say that that will depend on whether it's coherent with the narrative that the CPI print highlights. If it is coherent, then yes, it will still matter. If it's not, then CPI will take precedence.
Okay, well done. Nicely framed. Futures unchanged on the S&P. The jobs report 27 minutes away. Hour after that, the opening bell. Market set up as follows. Yields going nowhere on a 10-year, 383.27. Euro dollar not doing much either. 97.93 unchanged there. So you've got unchanged futures, unchanged euro dollar, unchanged 10-year. The thing that does change is crude this week. Crude has been absolutely flying over the last week, both the commodity and the energy names on the S&P 500. The commodity through Thursday up by around about 12%. The energy names on the S&P, Lisa, Bramo, a 15% move in 4 days.
And this is because of OPEC Plus coming out, saying that they're going to cut production by 2 million barrels, although the actual cut won't actually be that much because they haven't hit their production targets. This really raises an issue, though, of, first of all, spare capacity, and how much higher longer-term oil prices could really go. And I know you were speaking with Francisco Blanche about this over at Bank of America, and this really feeds to the narrative. It's going to be a tough winter.
He has some concerns about how we're using the SPR.
He does.
How it's been politicized and the risk that we could perhaps come across next year if we have a real crisis in the crude market. He was keen to point out we haven't had one yet.
And so if you end up with some of the lowest levels in the Strategic Petroleum Reserve, still there going back to the early 1980s, what kind of ability do you have to really offset some of those prices? And people raise the issue of going into the winter. Some of the diesel prices have actually increased quite dramatically. So how do they offset that at a time when that's going to be a bigger concern?
Operation Midterms. We've talked about it how many times over the last week? Operation Midterms. Is this the final jobs report before the next midterms, before the midterms election, or do we get one more? Because I wonder about the timeline going into the midterms and whether this administration can get there, the Democrats can get there before we start to see the cracks in the labor market.
I'm pretty sure that we have one more, but it comes after the Fed meeting, right? It comes at the same time.
In between.
It's sandwiched in between. So some really interesting moments, and I wonder what that Fed meeting is going to be like.
Canada's fascinating over the next month. It really is. Joining us now, I'm pleased to say, is Nadia Lovell, Senior U.S. Equity Strategist at UBS Global Wealth Management. Nadia, wonderful to catch up with you this morning. Those decelerating rate hikes from 75 to 50 to 25 that everyone's hoping, praying for, if they're bullish, that is that sufficient to add to equities here?
I think so, but we do expect the market to remain volatile. You know, these rallies that we're seeing, we continue to expect them to fade. I mean, the Fed remains determined to bring down inflation, and they have been clear to us that they will not blink nor even wink, and so even at the expense of growth. So it all depends on what the damage is to the economy at the end of the day, but we remain cautious in this environment, and we're more focused on the areas of the markets where we think that earnings are likely to be more durable in the face of any sort of economic slowdown. So areas like healthcare, as well as consumer staples.
And John, just quickly, November 4th is the next is a payrolls report.
What a week.
What a week is right. And it raises some issues about how quickly this market is moving. And Nadia, I would love for you to weigh in on that. I mean, do you have a sense that the circumstances are moving faster than the lagging indicators of a previous month's jobs report can really give us at a time of such change?
Yes, you know, the Fed has been aggressive, and so it hasn't had time to really stop and see like what's happening in the economy. We are seeing signs of crack. We're seeing slowdowns. Where we saw, earlier this week, we saw a decline in the number of job openings. We're seeing slowdown in areas like semis. We're seeing more people announce hiring freezes. We're also seeing some cracks in the housing market. I mean, look where the mortgage market is. And so by the time we get to the end of the year, though, we think that that's when the Fed is going to stop and pause and sort of look around and assess this situation. We are looking for a 75 basis points hike in the November meeting, but we admit that, the fact is that dots were really close in the last September dots between 125 basis points and 100 points by the end of the year. But we think that we get to 4.25% to 4.5% by the end of the year. And then after that, we think the Fed will remain on hold to sort of assess the lag that monetary policy tends to have on the economy.
Nadia, just moments ago, John was talking about some of the price action, really fascinating price action. It's not today. It's pretty dull in a lot of the asset classes, but not in oil, not in crude. And we have seen that this week, this real incredible rally on the heels of what happened with OPEC+. How has the recent sort of machinations and political backdrop affected your view on the energy sector at a time when at one point people were saying it's overbid heading into a downturn?
I would tell you, Lisa, we have been positive on energy for almost 2 years now. We remain positive. I mean, the rally in energy has resumed, and it's really one of the few sectors that's sort of in this uptrend and where we aren't really concerned about the earnings outlook. I mean, we continue to believe that oil prices, Brent is going to move above $110, around $110 by year end, and remain that way above that level into 2023. And, obviously the continued upward pressure on oil will come from like the end of the SPR. We also will see the seaborne ban on Russian oil later this year. And then also there's going to be this switch in dynamic happening, increased demand away from natural gas, given the upward pressures there and substitution for oil. So profits remains very healthy in this sector. And so we continue to remain very positive on the energy sector and see opportunities there.
Nadia, are we redefining how we play defense in a downturn?
Yes, I mean, it's sort of like traditionally you would lean into all of the defensive sector. We have two of those defensive sector, as I noted, healthcare and consumer staples. But energy usually has been a more cyclical sector. But we think that there's opportunities there because we're less concerned about the demand picture on that, even in a downturn, because the supply market remains so tight. So you sort of have to have a balance in this sort of new environment. It can't all be traditional defensive sectors.
What about the banks? How do they fit into that theme?
The banks, we've been neutral on financials just given the macro uncertainty and market volatility in capital markets. But as we head into the earnings season, banks kick off that next year. The banks might actually have a decent setup. They should be able to benefit from, net interest income side, given just the fact that we've had this increase in interest rates and also pick up in loan growth, particularly on the commercial and industrial and consumer side. But that might be able to offset some pressures on the fee side. But like I said, we've been neutral on banks. The wild card for banks remain provision for loan loss, and there might be some need for them to build up reserve depending on each individual bank's views on the economic slowdown and the potential to dip into recession. So near term, banks are okay set up, but as we head into 2023, there's some uncertainty.
Nadia, thank you. As always, Nadia Lovell there of UBS Global Wealth Management, going into the jobs report 20 minutes away, redefining defense in the equity market, talking about energy going into a recession. Crude briefly on WTI, $90 a barrel.
Other people agree with her, and you're starting to see that. And when we talked about earnings, people back out energy companies because they're leading the charge. I want to pick up on our point about banks and building some reserves. There was a report out, just theoretically, about banks that may have committed...
A theoretical report.
that may have committed to financing Elon Musk's bid for Twitter and how much they would stand to lose. And some estimates have it be $500 million based on where they price things out in April and where things are certainly currently trading if they sell all of the debt that they promised to finance.
When's JP Morgan? Next Friday. Look forward to that. Morgan Stanley too.
How are they going to cloak that?
I don't think you can. I think we've got to discuss it, haven't we? We'll do that next week. Sharon Bella-Goldman was on with me yesterday and was talking about perhaps the defense you could play, or rather a couple of days ago, the defense you could play in the European banks. They'd be more defensive than perhaps some people think. Did you see the story from the ECB this morning? The European Central Bank ratcheting up pressure on some banks to keep 22 bonuses in check amid fears about the darkening economic outlook. That's the ECB and what they think of banks going into a downturn.
Well, Credit Suisse is buying back some bonds, so maybe they're trying to fortify their balance sheet ahead of, whatever's going to happen.
Fascinating stuff. 18 minutes away from payrolls, Randy Krosner is going to join us, the economics professor at the University of Chicago and the former Fed governor. We'll do that shortly from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Coming up in just a few minutes, we'll get a look at the monthly U.S. jobs report. Now, it's forecast to show that employers added 255,000 jobs in September, and that would be the smallest number since a decline in late 2020. Now, still, it would be an indication that the labor market remains strong, and that could have an impact on what the Fed does next. The Nobel Peace Prize has been awarded to human rights activists from Ukraine, Russia, and Belarus. They were cited for documenting war crimes, human rights abuses, and abuse of power. At the same time, the chair of the Nobel Committee criticized Vladimir Putin and the government of Belarus for suppressing activists. President Biden has taken his first major steps toward decriminalizing marijuana. The president pardoned thousands of Americans convicted of possession of the drug. Now, he also ordered a review of its legal status. Meanwhile, the president's actions have given marijuana stocks in the U.S. a jolt. They're rising in pre-market. Tesla's all-electric truck will roll out before the end of the year. In a tweet, Elon Musk said production had begun and the first deliveries will head to PepsiCo December 1st. The big rig was first unveiled in November 2017, but the launch was delayed a number of times due to a lack of battery cell availability and a decision to focus on its consumer models. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
With inflation running well above our 2% goal, restoring price stability likely will require ongoing rate hikes and then keeping policy restrictive for some time until we are confident that inflation is firmly on the path toward our 2% goal.
Lisa Cook, the Federal Reserve Governor at the Peterson Institute for International Economics, her first address as Fed Governor. Very cool. Congratulations to her. Live from New York City this morning. Good morning to you all. Counting you down to payrolls, the number, the data, 12 minutes away. Equity shaping up as follows. Not doing much at all in the equity market. We're up about 1/10% on the S&P. Yields are higher by almost a basis point at 383. Euro dollar going absolutely nowhere at 97.92. Unchanged, Lisa, going into this one.
Except for one figure.
Crude.
Yes. And we're seeing that increase pretty substantially, up 1.6%, following a week of gains that really has been extraordinary, especially given the downturn that people are talking about, not only now, but over the next 6 months with what the Fed is going to do.
We're going to get things set for you. Mike McKee's going to enter the building any moment now. He's going to sit around this table. Randy Crozen's going to help us break down this number two. He joined us, the economics professor at the University of Chicago and former Fed governor. Randy, great to catch up with you, sir. The number about 11-12 minutes away. Walk us through what you'll look for, first of all.
The key thing is want to see if the labor market is beginning to weaken. I mean, since I'm from University of Chicago, I'll invoke Milton Friedman's famous phrase from 60 years ago that monetary policy has impacts with long and variable lags. And that's just as true today as it was then, that monetary policy, we typically think of as having an impact in 6 to 18 months. And it's about 6 months now since the Fed started its tightening cycle. So I think we're going to start to see some weakening in the labor market.
Randy, given the fact that you were once a Fed governor not so long ago, can you translate for us what we can understand from Chris Waller's discussion of basically point by point taking apart all of the bullish equity strategists out there, every argument that they have, and saying, nope, we're not gonna stop our hiking because of that, not because of this, not because of financial stability, not because of a slowdown in other non-employment figures?
Yeah, what happened was that after the late July meeting, I thought Jay Powell was very clear, and I thought everyone was very clear about what they were going to do. But the markets just wouldn't accept it. So everyone started coming out and saying, we're going to do it, we're going to keep at it. And then Jay at Jackson Hole ripped up his speech and said, I'm going to say one thing 8 times, which is we're going to keep at it. And I think what's now happened is the Fed has kind of entrenched themselves and kind of like, no matter what happens, we're going to do it, which I think is broadly the right message to be sending. But they should still be thinking with a little bit more nuance about, what the data will say, et cetera, et cetera. But I think they've kind of painted themselves into a corner, which probably is a good corner to be in because they really do have to execute on this. But I think they got there in a way because the markets just wouldn't believe what they were saying earlier on.
Okay, but you still have people who are kind of questioning it, Randy. I mean, you just heard Stephen Englander on this show basically saying it's like a parent saying, if you spend all of your allowance money, I'm not going to give you any money for lunch, and then they run out of their allowance money, and you say, okay, just kidding, I'll give you some, but don't ever do it again. And basically the market is saying that that's what the Fed is doing as well. I mean, are you saying the same thing, but it's important for them to stick with this message?
Well, actually, I think they are. It's not only the message, but I think maybe they really are saying, okay, we're not actually going to be as nuanced about the data, because you don't hear them saying, well, we're going to be data dependent. You hear them saying, we're going to keep at it until inflation is down. So that's a different way of approaching it. And so I think they're going to be pretty brutal going forward. I think they're going to get to low 4s relatively soon, and then I think they're going to stick there, and they want to make people clear that they're going to stick there. Now, of course, Mr. Putin could do some things that upend everything, but I think they're pretty strongly committed to this.
Randy, they're not going to keep hiking until they get down to 2%. They've basically told us that. They've told us that they're waiting to see a convincing string of evidence that we're heading in that direction. Where do you think inflation needs to be on headline to come to that conclusion?
Well, I think it's not just exactly where it needs to be on headline. So they focus on the personal consumption expenditure index, the PCE, rather than the CPI. That's running at a much lower level than the CPI is, since that's more in sort of the 5 to 6 or so range. It needs to be coming down. So they need to one, see the direction, and then 2, see that I would say probably they wouldn't start moving down until certainly it's under 4 and perhaps even under 3.
We're at 8 right now, so that's a problem. Randy, you're going to stick with us?
No, that's CPI.
Sure. What's that? Sorry, Randy?
So that's CPI. PCE is lower.
Yeah, no. So are you saying we'd have to be at 4 PCE or 4 CPI? Because I was talking about headline right now is at 8.
Oh, no. Well, they focus on PCE.
No, I get that.
That's their
no, I understand
engage.
That. Okay.
CPI, I mean, the relationship between CPI and PCE, sometimes they're closely related, sometimes they're not so closely related. CPI is going to be above that. I'm not quite sure, but they're not focused on CPI, so I don't really have a view on that.
Well, they change their mind every month on that, Randy, as you well know. 1 minute it's headline, it's core, it's you, Mitch.
Well, I think that's a little unfair. I think they've been focusing on PCE for a while. They do talk about all of the other pieces because, of course, that affects people's cost of living, and so it has an important impact. But I think for their prime decision making, it's going to be PCE and headline, but primarily core, because core really gives you more information about where things are going. Because it's always best to make policy in the front view mirror rather than the rear view mirror.
Randy Krosner, going to stick with us, going into payrolls, which is about 6 minutes away. Way more diplomatic than either of us, Randy, there on the Federal Reserve.
Which is the reason why he was on the Federal Reserve Governor Board, and neither of us are, not the only reason, but my point, I think, is that, he is, though, making an interesting point, which is originally it was about sentiment, which is the reason why we cared about the University of Michigan sentiment survey so much, and the idea of inflation expectations becoming unmoored. As inflation goes down, do they, sorry to use this word, pivot? I felt myself kind of hesitating back to the PCE, the core PCE kind of metric to determine when to really take the pedal off the brake.
I'd like to give Mike McKee the final word going into payrolls. The print about 5 minutes away. Mike's going to break it down. Mike, your number one thing you're looking for?
Job growth, because the Fed is looking for sort of a sequential slowdown. We could look at the unemployment rate and the participation rate, but the Fed's kind of gotten to the point where they don't think the participation rate's going to go up a whole lot more. So let's look at the headline number. But one thing Mary Daly said the other day.
What did she say?
We are data dependent, and data is a plural word. So they're not just looking at PCE, they're looking at every other inflation measure, and they're looking at the labor measures and UMich. They want what was the word? Totality?
The totality of the data.
Yeah.
Yeah, okay, that's helpful. Mike, looking forward to you breaking down the numbers. Jeff Rosenberg of BlackRock's going to be with us too. Randy Krosner back with us as well to break down that number in about 4.5 minutes' time. Going into it, here's how the stage is set for you. The equity market doing not much at all morning on stocks, on bonds, in foreign exchange as well. We're looking for 255,000, the previous number 315. Unemployment, the median estimate 3.7%, in line with the previous month as well. Wages in focus and a participation rate as well. Futures up by about 0.1%. The jobs number up next.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
Seconds away from the payrolls report in the United States of America. Mike McKee around the table ready to break that down for you. Futures totally unchanged on the S&P 500. A little bit firmer now, up 3 or 4/10%. With the number, here's Mike McKee.
Well, we come in almost bang on, John. If you're looking for 263,000, you've won. And the Fed might be looking for a number about that level. That's the change in non-farm payrolls from the month before. Private payrolls up by 288,000. The forecast was for 255 on the headline, 275 on private, so we come in very close to what the consensus was. The unemployment rate drops to 3.5%. Guess there is that we had fewer people who were looking for work. We'll take a look at that in just a second. Average hourly earnings up 0.3 on the month, and that pushes the year-over-year number down to 5%, which was what was expected. The labor force participation rate drops a tick to 62.3, so that's probably why we're seeing the unemployment rate do what it did. The change in private payrolls last month was revised down from 308 to 275. So it looks like we're getting some little bit weaker numbers. This is the kind of drop, a sequential fall that the Fed would be looking for to suggest that their medicine is kind of working, starting to at least.
I've got caught out too many times coming up with nice little neat narratives around the payrolls report and the market action, Mike, and then I've got whipsawed by the price action several hours later, but I can give you the knee-jerk reaction right now. Futures down by 0.75% on the S&P, positive by about 1/3 of 1% going into the print. Coming out of it, we are negative. Yields are higher at the front end by 7 or 8 basis points on a 2-year to 4.33, on a 10-year up by 5 basis points to 3.87. Mike, I wonder if we're picking up on the upside surprise on the payrolls report, just initially anyway, and that downside surprise in unemployment and participation coming down too. Put it all together for us.
The downside surprise in unemployment, in my mind, is what's doing it, because the number, number in exceeding the forecast isn't that great. It's 13,000 higher. We saw 11,000 higher for July revised up, but August isn't changed at 315. So labor market strength is about what it was, getting a little bit weaker. But then it becomes a question of who's getting the jobs and how many people are in and out of work. And I'm just looking here at the employment and unemployment numbers. The labor force falls by 57,000. Remember, it rose by 768,000 the month before. So that's going to account for why we're seeing the unemployment rate drop. The number of employed rises by 80,000, and the number of employed rises by 204,000. The number of unemployed falls by 251.
In some ways, on the margins, not an extraordinary move one way or another, but on the margins, this is exactly what the Fed does not want to see, because what you're seeing is a shift away from the perfect landing of seeing more people coming into the labor force and creating a bit more slack to potentially loosen some of the price pressures that you're seeing. How would you interpret this using the other data points, as Mary Daly pointed, because it's a multitude of points, in terms of how much further they are away from their goal?
It's hard to say that they're necessarily far away from their goal, because we did see the JOLTS numbers come down and the number of job openings are falling. And Mary Daly, the San Francisco Fed president, was in here the other day, and she was suggesting that the unemployment rate would trail other indicators because there are a lot of jobs available, even if they have come down. And so the number of people who lose jobs would fall as people could take jobs that were out there. So it may not be as bad as it looks. There are some, Steve Stanley at Amherst Pierpont, who thinks we'll get to 3.4% by the end of the year because of that. We're going to see a tighter labor market in the unemployment side, the household side, but we are seeing a drop in wages, and we're seeing a drop in the number of people who are getting jobs. So overall, a reasonable number for the Fed.
Should we do the totality of the data, so to speak?
I think
Next week, CPI, 75 nailed on?
Do that. Yeah. Well, 75 is the bar, and it's going to be hard to bring that bar down for the Fed. And this number would tell you that 75 is, what you want to do because the labor market is still strong enough. I don't think CPI is going to fall enough that we get down to 50, and I think, you're going to stay at 75 at this point because that makes sense.
We often describe payrolls guesses, Lisa, as throwing a dartboard with a blindfold on. Citi won that game this week. I think they went with 265. We ended up with 263. So congrats, Andrew Hollenhorst, to the team.
Congrats to Andrew Hollenhorst, but really, everyone deserves a congratulations.
Everyone gets a medal.
No, I'm not going to go there. But
get a participation trophy here.
Yeah, exactly. With participation rates going down, we got to get more people involved. But honestly, there is this feeling that the range was really tight. People got this correct in terms of where we were in terms of the labor market, which is a surprise because it's been different.
Left-wing of you. Everyone gets a medal. Futures down 0.5% on the S&P. That's a joke. It's a joke. Before the messages start, it's just a joke. The space for humour. Mike McKee, thank you. Randy Krosner joins us now, economics professor at the University of Chicago Booth School, former Fed governor. Randy, we'd love your reaction to this. Futures down just a little bit. We're off 0.4%. Your thoughts on this report?
So I think exactly as you were describing, it's going to keep the Fed on track for a 75 basis point move at the next meeting. It's broadly within the parameters of what they were expecting. As you had said, that they were hoping that they'd still see a little bit more uptick in labor force participation, but they didn't get that. They do. I think they are expecting that the unemployment rate will start to move up a bit. Something that'll be heartening is that we didn't see an acceleration in wage growth. So that isn't taking off. That would be the most problematic thing for them because that would suggest inflation expectations or inflation really becoming quite entrenched. And so I think that's the other key thing to be looking at going forward. Where is wage growth going? And so far that at 5%. Obviously, that's much higher than it has been, but certainly lower than pretty much any measure of headline inflation.
Randy, I want to stick on participation rate for just a minute. We haven't gotten back to the pre-pandemic levels, and a lot of people were hoping for a soft landing where you have more people come into the labor market who were sort of sitting out during the pandemic and the direct aftermath. How does this rejigger the expectations of the Federal Reserve, of this labor market, and how much it's been transformed post-pandemic?
Well, I don't think this one report is really changing that, but I think they're gradually coming to realize that a lot of people are just not coming back in. For example, older workers, labor force participation had been quite high before the pandemic, and now it's significantly lower. Older workers found a lot of people that they knew didn't make it through COVID. They want to be able to spend time with their families, and so I think those they're much less likely to come back in, and that's a challenge for the labor market because those are the most skilled workers. And this is one of the challenges that we're seeing now: this skill mismatch. That there are a lot of openings, but there aren't people who have the right skills for those jobs.
Randy, I just have to point out this tweet from Ivan the K. On Twitter, reminder, be sure to fit today's labor market report into your narrative, even if you need to use a shoehorn. How does the narrative change, or what should the narrative be heading into year end as we look at the totality of data, and try to understand where we are in this economic cycle?
Well, I mean, we're fortunate that we still have a very strong labor market, and so people have a lot of job opportunities, despite the Fed having moved interest rates up so much and so quickly. But as I had said before, monetary policy has impact with long and variable lags. So typically it starts having an impact in about 6 months or so, and we're getting to that point. So I do think that we're going to start to see the labor market weaken through the rest of the year. But the Fed's going to keep at it. There's nothing in this report that is going to suggest to them that they need to pull back. They're going to continue full bore towards 4+ by the end of the year, and then somewhere in the mid 4s or so they'll closer to 5, they will stop. But that will then depend on the data and how things are evolving next year, and also the uncertainties of what Mr. Putin might do.
Hey, Randy, we appreciate your time today, sir. As always, looking forward to next month's conversation. Randy Krosner there of the University of Chicago. Futures down off the back of this by 6 or 0.7%. Yields up at the front end of the curve. That's the response to the number we got just moments ago. We're up 6 basis points on a 2-year to 431. Call it 432. On a 10-year, yields up by 5 to 388. Coming up in the next hour, catching up with Rick Reeder of BlackRock, Anastasia Amoroso of iCapital Network, PGIM's Mike Collins. Then at 9:40, the reaction from the White House. Lisa, looking forward to catching up with Secretary Walsh in the next hour. Something for everyone in this jobs report, right?
I really enjoy that Twitter post where basically people are saying you can find anything you want, take your narrative, just use shoehorn, stick it in there. I mean, that's basically what's been happening. However, one thing that is quite clear, this labor market is still pretty resilient. You are seeing that resilience in the economy, which is the reason why some people are arguing that the soft landing scenario looks further and further away, simply because they're going to have to do more to stop this ship.
If you ask people in America right now, what are they more concerned about, losing their job or high inflation? I wonder if the same answer that they would give you is the same answer you'd get from the Federal Reserve right now. I suspect it might be. And for that reason, this Fed has probably got more work to do, right?
I think that that's basically what Mary Daly was saying, and that was
precisely what she told
exactly what she was saying. And it comes at a time when people are seeing a punitive level of inflation. It's hurting the lower income brackets.
I'm going to run, Lisa.
Have a great time.
It was a great weekend.
Fun. You too. Have a great one.
Weekends post-pandemic start on Thursday afternoons. You know this, right? And I guess on payrolls Friday they started about 8:40. But stick around for Bloomberg Real Yield a little bit later too. You can make it that far.
Not that you're bitter or anything.
Not at all.
Thank you for that. And honestly, I'm really looking forward to hear what Marty Walsh has had to say. Mike McKee, before we get on to our next guest, I'd love your take. You've been parsing through the data. What have you discovered in terms of some of the nuances underneath?
Well, we looked at what happened with the unemployment rate, but the interesting thing about employment is that we did see a seasonal effect, it looks like, in education. State and local education lost 21,000 jobs, which is going to be seasonal because in September everybody comes in. So they didn't hire quite as many people as they thought. The seasonals pushed that down. And so we probably would have had a little bit bigger number, but we did have a big gain in August. And maybe some of the school districts have moved their business to August, moved the start of school year to August. So we're seeing some numbers come in there. And then retail sales, retailers gained only 1,000 jobs, even though service-producing jobs were up 264,000. Most of it comes in temporary help and business services. So maybe companies are doing the opposite of what they do when the economy is getting better and they hire people temporarily till they know they really need them. Maybe now they're beginning to think, well, maybe we don't need as many people, but we still have business to do, so we'll use some temps.
And the retailers have been in a tough spot. Levi Strauss actually just reporting some negative earnings, those shares plunging, which is a story we've seen. And how much do we start to see the negative earnings revisions on the heels of some of this weakness and expectation of that? Jeff Rosenberg joins us now following the labor market report that we got pretty much bang on for the expectations. BlackRock portfolio manager of the Systemic Multi-Strategy Fund. Jeff, your take on this particular jobs report?
Yeah, Lisa, I think you hit it on the head earlier in your reaction to the unemployment rate and the labor force participation rate. I think that's why you're seeing, a little bit of negative reaction in the front end of bond curves, a little bit of negative reaction in in equity futures. I think this is a slight disappointment relative to hopes that, this report would give a piece of evidence in favor of the camp that there's a slowdown and a pivot underway. And I think that's going to be disappointed in this report. It's one report. It's probably not even the most important report. Next week, we'll get the most important report, which is the CPI report. But I think in total, that's really the numbers that sort of stand out to me is the failure to see an increase in the participation rate. And that's really about the forward-looking view on wage pressures. So yes, the wage pressures didn't go up, but they're still exceedingly high. And while they stay high, that is the source of the other camp's view, which is that we're in a wage price spiral. So I think it's a little bit disappointing to the dovish camp, a little bit reinforcing to the hawkish camp. minor on both sides of the argument, but definitely tilting that way. And that's why you're getting the market reaction you are today.
So we get a lot of fund managers on the show, and they always say, we're not trading every day. We're not an algo. And they say, you know, we have a certain approach and we kind of move along. How has your approach shifted as you get the multitude of data that we're getting? And how much are you looking to change it heading into year end?
Well, it's a great question, Lisa. And the issue is the degree of uncertainty here with regards to the inflation outlook. And it's very hard to forecast. So we have a little saying, if you don't have a good forecast, then observe. It's sort of what the Fed is saying in terms of being data dependent. They don't know what the trajectory of inflation is going to be, and so they're going to observe. So it's very hard to kind of trade every little change and turn in the data. We take a step back and we look at the overall trend. And as I just highlighted, this is, you know, one piece of information that's a little bit in the camp of the hawkish camp, that the Fed needs to do more. But no one really knows where inflation is going to go. And we have expectations, however, in the bond market and the consensus view of a relatively benign amount of impact to the economy for a dramatic decrease in the amount of inflation. And I think the weight of the proof of that being the correct view is on that side of the argument. And so I think it's highly uncertain, and today is a little bit on the hawkish side.
You can't trade every little data point, you say, but yesterday we saw jobless claims up just a little bit, still very, very low, and markets turned around. When are they going to get the message that the Fed is sending and just kind of sit back and let the economy go, because the Fed isn't going to change its mind?
Well, you know, the Fed is sending mixed messages, right? If you look at the distribution of the out years SEP median Fed funds expectations, they're all over the map, and they represent basically it's time to slow and we want to avoid the over tightening camp to we need to get inflation down, and that's job number one. On top of that is a very strong history of central banks reacting to financial stability concerns. You know, right now, with a strong labor market, this is the relatively easy part of the Fed's tightening cycle. And I think they're trying to get as much as they can under their belt while labor markets are strong. When you start to see significant financial stability concerns, and when you start to see the slowdown that they're hoping for and anticipating in the economy and in the labor market, the job is going to get that much more difficult, both for the Fed as well as for us and financial market participants.
Jeff, how comfortable are you right now with market pricing that we're going to get rate cuts as soon as late next year?
Well, that was really what I was kind of referring to, is that we've got the rate cuts priced into the market. We've got a slow but steady decline in inflation forecasts and consensus forecasts, back down to 2%, back down to the pre-COVID environment without a tremendous amount of tightening required. And I think that remains a challenged view as we see how the data develops. Today is a little bit in favor of that view. We haven't seen the significant tightening yet. Yes, monetary policy operates with a lag, so we're waiting on those lags. But the real disappointment and the real issue for markets will come next week, because we haven't seen the slowdown in core CPI. And that's the bigger concern. And it weighs into the argument that Summers and Jason Furman are making, that the market is off, the Fed is off with respect to their forecasts of how much tightening is required, and that there's going to require a lot more tightening before we see the decline in inflation that is in market expectations. So I think those declines in the second half of next year, that very much remains to be seen. We're a little bit cautious on adopting that view right now.
Jeff Rosenberg, portfolio manager of the Systematic Multi-Strategy Fund at BlackRock. Thank you so much. And Mike, I'm really struck by this discussion of the fact that we're going to have to get to a much higher terminal rate in order to slow inflation. And all right, this labor market report, pretty much in line with what we were expecting, doesn't matter anymore. Now it's CPI.
It is CPI, and it's always been CPI. Inflation, put it that way, because the Fed does, as you were discussing earlier, follow the PCE numbers. But CPI is the proxy, and CPI gives us the biggest breakdown of where inflation is. So next week's number is going to be very important. In a sense, the Fed has said 75, so unless inflation absolutely collapsed, they're going to do 75, won't change their mind there. But what they would like to see is some progress in bringing down some of these prices.
And we were speaking with Anna Wong of Bloomberg Intelligence earlier, and she was talking about how she could see a 5% Fed funds rate, that's ultimately where they're going to get to. How divergent is that from the rest of Wall Street?
It's not as, well, from Wall Street, it's higher than Wall Street wants it to be, so it's higher than most of the forecasts. It's not that divergent from where the Fed is, because most of them have marked up their numbers. They're between 4.5 and 5. So if inflation proves sticky, you'll see those numbers go a little bit higher, maybe over 5. Given where we are now, they think that if you get to between 4.5 and 5, that's going to be enough to put the brakes on inflation in the economy, but we won't know for some time.
As we look right now, we're looking at a 2-year yield of 4.32%, touching earlier the highest levels going back to 2007, just off some of the initial highs. But nonetheless, a knee-jerk reaction that this will give the Fed more rope to continue to hike rates aggressively into year-end and potentially beyond. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joining us right now. Ira, your take on this labor market report?
Yeah, so I think I agree with some of the former guests, basically saying that you can find anything if you're hawkish or dovish in this report. I think generally speaking, it was middle of the road enough that it will keep the Federal Reserve on the hiking trend. I agree with Mike McKee that the Fed is likely to go 75 basis points in November. There's nothing in this report that should change that outlook. I think something that's interesting that we've seen, just in the market post the initial knee-jerk reaction was that the yield curve has actually steepened a little bit. We were flatter going into the number. The 2s-10s curve was a couple of basis points flatter. Now we're about a basis point steeper on the day, and that might reflect just some of the forward uncertainty that some of the incoming data certainly represents. And when we look at the Fed funds futures about the terminal rate pricing, we are starting to price finally for the Fed to stay at its terminal rate a little bit above 4.5% for most of 2023 now. So before we were talking about early cuts, now the market's only pricing maybe one cut in 2023. So I think that's a significant change since over the last couple of weeks since the last Fed meeting.
Ira, I'd love your take on what Jeff Rosenberg was just talking about, that perhaps some of this data is really highlighting the point that was put out by Larry Summers and a number of others, where they're talking about the Fed funds rate needing to be much higher than people previously expected because of the stickiness of inflation, and perhaps we'll get that with CPI. Certainly with the labor market, it is holding in much more than people thought. Are you sympathetic to that view that the terminal rate is something closer to that 5% level of your colleague Anna Wong?
Yeah, so we've been above at 4.5% or a little bit higher than that since May. So we're now pricing for our forecast. I think the Federal Reserve can hike to around somewhere in that 4.5 to 5% range. Call it 4 3/4 on the upper band, which is exactly what the market's pricing right now. But by the way, and then hold it there for a while, right? Because the Fed at some point is going to say, look, the long and variable lags point of view, where once we get to that level, we can hold it there for a long time. Now, from a market dynamic standpoint, if that's what happens and the market starts to expect the Fed to be on hold for, say, the better part of a year and a half at say 4 3/4 on the upper band, that means something like 2-year notes can probably sell off a little bit more, but not much, given where they're currently priced. The question then is, what does the long end do? Does the 10-year and the 30-year, do they expect a reacceleration of inflation inflation and the Federal Reserve to have to hike more, in which case you probably get a steeper curve or less inverted curve than you have right now. But if the market is thinking that, hey, we're going to go into a recession, which I think is still more or less the consensus, that then you can wind up with even a flatter yield curve, and you can see 10-year yields rally a lot more and see maybe 3.25% 10-year yields next year, where you still have this relatively high 2-year note yield. So I think it's really the curve dynamics that are going to be interesting, and I think some sectors like the financial sectors, for example, like banks, that can seriously affect some of the earnings potential outlook in some of those sectors.
Ira Jersey of Bloomberg Intelligence, thank you so much for your insights. As always, Mike, what do you make of this whole discussion of a fully employed recession, of something where we don't necessarily see the labor market participate in something of a downturn that, as Ira was saying, is sort of turning into a base case?
Well, employment is lagging, first of all, so from history you know that it's going to take a while to come down. This has also been a very unusual economic recession and recovery. A lot of supply issues. We shut down the whole economy, reopened it, and a lot of people dropped out of the labor force. So it's kind of hard to get a good read on all of that. But I think the bottom line from all of this is that what's going to happen is going to take time. It's not going to be an immediate collapse in inflation. It's not going to be an immediate collapse in the economy. Atlanta Fed GDP now 2.7%. We'll see what it is after today for the third quarter. So a big rebound in growth at a time when the Fed is raising interest rates. It's just going to take time for this to play out, and the people on the Wall Street trading desk are going to have more patience than perhaps they do.
And perhaps it's going to be a little bit more immediate when it comes to corporate profits, and we've seen that from a number of companies. Gina Martin-Adams has been tracking it, and she joins us now, Chief Equity Strategist for Bloomberg Intelligence. Gina, in your examination of some of the recent earnings reports and guidance that we've gotten out, how much and how quickly is the mood shifting in corporate executive C-suites rather than just looking at these sort of broad macroeconomic data?
Of this year, we've seen companies migrate from their primary concern being inflation to their primary concern being a combination of the extreme currency volatility that has been recorded over the course of 2022 and a recessionary-like slowdown in growth conditions. We've definitely seen this start to show up in consensus estimates as well. As far back as June of this year, analysts were forecasting 10% growth in earnings for the third quarter earnings season, which we're about to go into. Now analysts are anticipating 3%. Certainly the market itself also has started to forecast an earnings recession emerging. Our model would suggest that at our September lows, provided an assumption that the bond market had the outlook for rates correct, the market was pricing for a 15% correction in earnings over the course of the next 12 months. Even if you get more aggressive on the rates forecast, you suggest that ultimately that terminal rate does get to 5%, and reflecting that the 2-year yield needs to get to 5% over the course of the next 12 months as well, our markets were already pricing a 5% correction in earnings. So the market is well ahead of what's likely to happen in the economy and has even forecast a pretty severe recession.
Pretty severe recession. Is it in all sectors, or is it specific to the retailers, specific to the semiconductors, specific to sectors that can remain insulated from, say, some of the broader names that make up the index?
Well, if you look at consensus expectations as a proxy for what we are likely to expect for the third quarter, the analyst consensus thinks that 6 different sectors are likely to record an earnings recession or a drop in earnings relative to that of a year ago as of the third quarter. In the second quarter, it was 3. So there is a clear spreading of weakness going on. Energy is absent the weakness. Energy is still experiencing double-digit earnings growth gains, but that's likely to change going into 2023. So what we have seen is a progression of weakness and a broadening of weakness to more and more industries and sectors. The weakness is predominantly about margins still, as opposed to revenues, but nonetheless, even the revenue forecast is deteriorating.
But Gina, I actually want to pick up on this, and just in the minute that we have left, how surprised have you been that they're willing to sacrifice margins and to not lay people off to cut costs in order to preserve workers through a cycle after just getting burned by not having enough people or being able to bring people back after the pandemic?
Yeah, I think it's a very difficult cycle, frankly. So I think this has been a surprise, but also sort of a consequence of the duration of this cycle. We were just in recession in 2020. So we haven't had the opportunity to really develop sort of a full economic cycle and then see removal of some of the excesses that typically develop in an economic cycle drive recession. So this recession is a consequence of very different factors than the normal type of earnings recession. A lot of it is, frankly, very tough comps from a year ago, because remember in 2021, we were experiencing extraordinary earnings growth after the 2020 correction in earnings growth. So it is very complicated. It's a much different cycle than is the norm. And inflation is clearly also in a very different position. Much of what we're seeing on margins is simply reflecting input cost changes and input cost volatility, which is clearly quite different than companies have been contending with for a long time. You have to remember that over the last decade, we've had very, very suppressed inflation, very low inflation volatility, allowing for margin expansion to sort of persist.
Yeah.
This is a very different climate this time around.
Gina Martin-Adams of Bloomberg Intelligence, thank you so much, as always, for your insights. Right now, we are seeing about 31 minutes from the opening bell. We are seeing the market continue with its decline, with S&P futures lower by more than 1%. You can see across the board, yields up, stocks down, pretty much the playbook that we have seen. Coming up on the open on Bloomberg TV and Bloomberg Radio, Marty Walsh, U.S. Secretary of Labor, to respond to this particular report to a strong labor market in the face of inflation. This is Bloomberg.
Lisa said it, yields up, stocks down. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue. It's Jobs Day in America.
The jobs report.
The U.S. labor market data.
We still have a very strong labor market.
It's going to keep the Fed very much on their mission.
We're in this period where every miss or hit or every economic information becomes so important.
The Fed has been very explicit. Until we see concrete signs of inflation peaking.
Until we see a change in what's happening in the labor market.
They are going to be tone deaf to slowing in the economy.
Participation is really the key to the Fed being able to pull off that soft landing.
The participation rate has been so critical.
It's a huge element.
They are talking very tough. They're sticking to a script.
They're going to want the data to tell them to start to cut.
There's nothing in this report that is going to suggest to them that they need to pull back.
Let's get that data with the numbers. Here's Mike McKee. Morning, Mike.
Morning, John. Slightly stronger than expected. 263,000 jobs added to the payrolls in the month of September. The August number of 315,000 was unrevised. The unemployment rate, though, falls to 3.5% as the participation rate drops a bit. 52,000 people dropped out of the labor force. Last month, we'd had 768,000 additional people in the labor force, and that's why unemployment goes down. Average hourly earnings come in bang on expectations, 0.3 for the month, and a 5.2% for the year, or 5.0% for the year, which is a little bit of progress for the Fed. In terms of the jobless story, Black and Hispanic unemployment, 5.8% and 3.8%, both of those drop from the prior month. The U6 drops to 6.7%, and as I mentioned, 57,000 people fewer in the labor force, while employment went up and unemployment went down in the household survey. There are some interesting changes. We would have had even more stronger report if we'd spread the number of teachers and education workers over August and September, because more went into August than in September. Seasonals pushed down the overall numbers for education. But service providing, look at that, 244,000. Of those service jobs, retailers were gained just 1,100, and professional services was the big winner, 46,000. Do companies, are they hiring at this point on the temporary side because they're not sure where the economy is going? Real estate was the last number I had on there, 5,000 jobs gained. That was the sector that was supposedly collapsed during the month. So it's kind of hard to know what happened there. Bottom line, participation rate falls, and that makes the unemployment rate go down. More people hired than lost jobs, but participation is the key to the unemployment rate this time.
With that in mind, Mike, do we have to put our soft landing supply side dreams on hold?
No, I mean, you've still got a soft landing in these numbers because you've got a fairly strong payrolls report. 263,000 is above the 191,000, which was the average for the 5 years before the pandemic. So still a strong report. 3.5% ties for the lowest that we've had. So at this point, it still looks good in the labor market, and with average hourly earnings going down, the Fed is on track, at least, to get to where it wants to be.
Mike McKee, thank you. How much pain, how much damage will they need to cause to get there? Futures down by 1.25% on the S&P. The conclusion for many is this Fed has more work to do. Yields up at the front end by 4 or 5 basis points on a 2-year, 430. On a 10-year, 388, yields up around about 6 basis points. Pleased to say, Rick Reeder joined us now from BlackRock. Rick, wonderful to catch up with you again, buddy. Let's start here. Your response to that jobs report?
It's solid. I mean, I think the commentary, I think what Michael said is right. I mean, it's solid. You know, to have these numbers, you know, this far in a cycle is still pretty impressive. That being said, I think you have to put a little bit of perspective on it. You know, the number, if you take the 3-month average, so we got 260,000 jobs-ish. The 3-month average is 375. The 6-month average is 475. So deceleration, but it's still solid. I mean, you look at the job openings that we got this week. You know, you had job openings coming down. You look at the claims data up a little bit. So, listen, it's moving in the right direction. Today was solid, though. I mean, I think all the commentary about it's just, you know, you've got an economy that is still operating at a pretty good level, and the Fed's got to keep going.
Spent the week saying bad news was good news. Is solid news bad news? Which one is it?
So I will say, by the way, this felt like another month this week. You know, by the way, the discussion earlier this week that was surreal to me, Jonathan, around Fed pivot, Bank of England does something because the pension system is having a challenge, that maybe this is a sign of a pivot or put by the central banks. I thought that was bizarre. There's no pivot. The Fed has got to keep going. And, you know, today for markets, listen, softening of the data is something that we're going to want to see. By the way, when we get the CPI report next week, we're going to want to see some softening. If it's not, you know, that puts you in a tough spot for the Fed, and financial conditions will continue to be under pressure. It doesn't give you come in every Monday morning. It doesn't give you like, let me get more financial assets on board when you're in that sort of environment.
Rick, I was listening to a podcast that you did with Meb Faber. Congratulations to you both, by the way. It was a fantastic listen for me over the weekend. And just listening to you both talk, just seems like, Rick, you've never been through a market like this before. You sound exhausted after this week. What a month the last week has been again. What are your thoughts on that?
So I would say there are 2 parts of it. One, it is the most exhausting. I mean, trying to parse all this data. And by the way, you know, spent a lot of time looking at corporate earnings and what's happening to margin pressure. Is business spend going to slow? Because I think that's going to trigger. Is business spend going to start to come off? So, gosh, there's a lot you got to go through. I mean, I seem to get up a few minutes earlier and go to sleep a few minutes later every day. That being said, Jonathan, I mean, what you have to take some thought on or perspective on is if you're a fixed income investor, the next few years are going to be, I think, extraordinary. You're pricing yields to levels that we haven't seen. And I know it's, I think, on that podcast as well. Like you can sit and wait in cash in short duration assets and get paid very well for it. This is creating an environment that, you know, the markets have to recalibrate every few years. This is a massive recalibration. By the way, Jonathan, my partner Bob Miller reminded me this morning that in March the funds rate was at 0 and the Fed was doing QE.
Yep.
And you think about now we've got our price and terminal funds rate, you know, closer to 475. That's a lot of movement in a few months.
They've done 300 basis points in 6 months. I think it took them 3 years to do anything close to that in the last rate hiking cycle. Rick, you said a few years, and I just wonder, can we get to that new equilibrium with Fed funds in and around 4? Can we get there and stay there?
So listen, I mean, I think the Fed said you got to keep going. I mean, there's something that's really important per my comment. You think about where we've gotten to, your point about how much they've raised the funds rate. And then, by the way, they're draining liquidity. If you think about since where we were in December, you've drained $1.3 trillion of liquidity. You've drained $300 billion in the last month. rates higher, liquidity getting drained. By the way, this will have an impact. And so part of why I think the Fed's going to get to the number and then pause for a while, and I think you get a 75, you probably get another 50, we can debate another 25. You just did an immense amount. You've got to let the system, you've got to see what happens to business spending, what happens, you see these openings drop like a stone, job openings drop like a stone. So I think you got to see a little bit. When people say you got to keep going, listen, the Fed was easing too long. Now they're tightening unbelievably, historically aggressively. Think about it. If they go too far, then you got to start easing again. It's crazy. I think you've got to let the system recalibrate. Let's see, because this is historic amount of monetary tightening.
Rick, you've been in cash for a while. You've carried high levels of cash through much of this year. We've talked about it a fair bit. If they start to decelerate rate hikes from 75 to 50 to 25, is that sufficiently good news for you to say it's time to add a bit more capital?
So, Jonathan, in the next month, you think about what we're going to have happen. We got the CPI data coming out next week. We're going to hear more about the party Congress. We're going to hear more about the war. We're going to hear more about UK utility prices. We got a lot of data coming in the next month or two. If the data, we've been getting a lot of bad news. If the data starts to suggest, economy in the U.S. moderating, we're getting through some of these exogenous shocks in a bit better way, or at least we know what the news is 30 days, 60 days hence, then yes, we'll start to put some money to work. And then you start to feel better about beta. Cash will rotate into equities as opposed to now. I just don't find it very exciting at all. We'll rotate a bit more in equities. You can now, instead of taking, front end, like I've been buying commercial paper. I bought commercial paper in 20 years, 15 years, 20 years. Gosh, now you can press more into the high yield market. Dollar stabilizes, maybe EM, but I still think you need 30 to 60 days. Let's see the data and let's see these developments. And then, if you get that deceleration and it looks like the Fed's going to pause, you could have a pretty good environment.
Rick, what do you make of how credit's priced at the moment in high yield? I look at spreads, and spreads don't scream recession. I look at price and yield, and maybe some of that is saying buy me. What do you see?
I'm closer to the latter. I mean, I think you're right. The spread's historically not that interesting, but you also have to consider that default rates are low and companies have termed out their debt and they're sitting on a lot of cash. And the structure of the high yield market is better because the energy market that created the duress a few years back is actually in better shape. So if you take the fact that the risk-free rate is now pricing at an attractive level, that, you build that spread on top of it, and you can buy high yield at 8, 9, 10, depending on how much risk you want to take. I tend to like it. That being said, I would say our positioning is moderate because I still think you've got these things to work through. But listen, at the end of the day, if you said to me, would I rather book a 9 than worry about equity beta with margin compression and earnings flatlining to I think slowing, I'd like to take income into the portfolio. I think carry is pretty attractive. So I lean on the side of, by the way, I like it a lot more than real estate today.
Yeah.
When you ratchet the mortgage rate up. So I tend to like it, but listen, I think you got to be reserved in the size of your positioning today because of all the aforementioned.
Rick, the risk at the moment for many people, particularly over the last few weeks, has been in the risk-free asset. And one question I've asked a few times, and I'd love your response to it, if we're struggling to price the risk-free asset up 20 basis points, down 20 basis points on any given day on very little information, how do you price risk assets?
I mean, that's why liquidity in the markets, John, is so atrocious. It is, you can't. I mean, it's so hard. I mean, it's, every financial asset we look at is the risk-free rate plus the risky rate. And if your most conservative part of that equation is bobbing all over the place, you can't. It's super hard. You've got to expand your bid ask, as it were, in terms of, what's your entry point on an asset. And I think that's the way you're going to be for the time being. But I just want to put this a bit in perspective. Sure. It is my favorite asset. Amazon, 2.25 years ago, when rates were at 0, issued a 3-year at 0.25%. We were funding Amazon at 25 basis points. It's now a 9-month bond that you can buy at, I don't know the exact level today, but it's back of 4%. And so you think about that. Now I'm funding, because of the risk-free rate, my real rate of return on the asset, pretty good. Particularly you look at inflation break-evens in and around 2. So it was a pretty interesting time to say, gosh, I need to expand my time horizon a little bit on assets that are yielding these sort of levels. And these are particularly if you can see in the front end. If you buy now a 3-year asset that's a 1 year or less or a 9-month with a nice yield to it, that's pretty intriguing.
So, Rick, this gets me to the final question. You just talked about the change we've seen in Amazon in a few years. It feels like a few long years. We've just blown up a decade of negative rates, even negative rates in the corporate bond market, zero rates at the Fed, QE, trillions of it. Rick, there are some people out there that just struggle to believe that we've fully realized the spillovers from that we can really go through the next couple of years without the default rate picking up a fair bit. What do you say back to them?
How much longer do we have?
You can have a couple of minutes.
I think it's really hard, Jonathan. I mean, listen, I don't think it's a given that you assume that, boy, now the thing has to break. Listen, I hope negative interest rates is finished for the rest of my career. I don't think it works. I think you create these anomalies in the system. I don't think it adds to velocity. It penalizes your pension system, your insurance system. It dulls investment. I don't believe in it. But what it did allow is it allowed companies to term their debt out. It did allow companies to get healthier. And so to say, we've got to see all of this unwind. Well, you're gonna slow an economy with a paradigm where you've actually got, by the way, not just companies, households. The household wealth and debt ratio is much better. The lowest part of the income strata is in a tougher spot. But generally, consumer leverage is okay, financial leverage is okay, and corporate leverage is okay. So, whether low rates allowed you to do all that, there is a fair argument to that. So, to say now it's going to unwind, it's going to create a problem, the system's in reasonable shape. By the way, the debt's on the government's balance sheet, which is not perfect, and will dull your fiscal expenditure, certainly the cost of your fiscal expenditure. But listen, I think the starting point is reasonable, and to say, gosh, now the thing's going to tip over and it's going to get a lot worse, I don't see that. What creates stress in the system is leverage. I mean, in every time we go back to Asian crisis, et cetera. Now the leverage is not bad. It's on the government's balance sheet, which you can handle a bit better. By the way, some parts of the world that are dollar liabilities, not so much. Yeah. But you can generally handle it a bit better. So I'm not in the, gosh, this thing's going to be a disaster. I just don't buy that. And by the way, I don't think soft landing is an impossibility per what we're seeing play out today. But again, we got to see a lot of exogenous things, global dynamics play out over the next couple of months.
Hey, Rick, awesome to catch up. I know you don't rest much on the weekend, but get some rest. We've got to do it again Monday. Rick Reader there, BlackRock. Thank you, buddy, as always. Futures down about 1% on the S&P. Yields are higher. Coming up, the payrolls report. Keeping the Fed on track.
We just now need to stay the course. We said we're going to do this. We need to follow through and validate the expectations that we set in markets.
Payrolls and politics, what the latest jobs data means for the Biden administration. That conversation up next with iCapital's Anastasia Amoroso and PGIM's Mike Collins.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
I think we're quite a ways away from a pause.
Restoring price stability likely will require ongoing rate hikes.
Somewhere between 4 and 4.5% by the end of this year.
I anticipate additional rate hikes into early next year.
Headed for 4.5 to 4.75% by sometime next year.
And then hold at that level.
As we continue to move into more and more restrictive territory.
Can we achieve a soft landing?
Until we see inflation truly get close to 2%.
Stay the course.
We're all waiting for inflation to peak.
I'll be watching the data carefully.
That's going to be really critical for policy making.
Stay the course. Fed officials sticking to the script and doubling down on their plans to tame inflation. The latest payrolls report giving the central bank a green light to keep going. This, as the Biden administration faces a string of economic tests ahead of midterms with CPI, GDP, and another rate hike still on deck. Bloomberg's Anne-Marie joins us now from D.C. Morning, Anne-Marie.
Good morning, John. Well, we're still waiting for a statement out from the president on what the White House actually thinks of the latest jobs report, but they're going to take this and likely say it is good news, especially that unemployment rate, 3.5%. Not only does it match a pre-pandemic low, but also comes in line and matches a 5-decade low. So they're going to say their economic strategy, as well as seeing above trend in wages, that it is working. But Jonathan, the issue is jobs, unemployment. This does not come up in the polls. The issue is inflation. So for this administration, what voters care about is next week's CPI.
AMH, thank you. I think next week's CPI is going to hijack pretty much everything. Anne-Marie down in Washington, D.C. Joining us now is iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, wonderful to have you back. Your response to the jobs report 50 minutes ago.
Well, it came in right under the nose in line with expectations, but unfortunately the challenge is this shows that the labor market is slowing, but is really not weakening. I would say there's broad-based strength. I think they want to crack the labor room for because we kind of can see this train, wreck in motion, in slow motion, so to speak. We know that the labor market is going to continue to slow, and at the same time, the Fed is going to continue to hike. So between those two things, it's really tough for equities right now.
And Mike Collins, your thoughts on this? And I just want to throw in this quote from Ian Shepherdson of Pantheon Macroeconomics. He says the following, and on Twitter, "It's just hilarious that stocks are cratering after a statistically insignificant dip in unemployment and a statistically insignificant increase in the labor force combined to generate statistically insignificant falls in the unemployment rate and participation." Mike, I don't know if you got all that, but your response to it, please.
Yeah, I mean, this is good news for the economy, right? It's good news for those in the soft landing or the moderation camp. It's good news for people who want to hold on to jobs. It's good news for confidence, for consumer spending. But as we all know, it's all about the Fed. It's all about central banks, Jonathan. It's all about monetary policy, how tight it's going to get, and it's priced to get really tight, and the markets are reacting to that.
Anne-Marie said it. It's all about CPI. Next week is going to hijack the whole story. Anastasia, you know how this goes for November. If this Fed sets the stage to go from 75 to 50 to 25, Rick Reeder and I spoke about this moments ago. Is that sufficiently good enough for you to add to equity exposure?
No, Jonathan, I don't think so. I think it might be sufficient to create some sort of short-term bounce back, and that's what we've seen play out in the markets this year. But the reality is this is the Fed that is heading into a restrictive territory, and the markets need to account for two factors. First of all, we're going to have depressed valuations. There's no reason for that multiple to expand, so that can't be the driver of equity returns when the Fed is clearly holding rates in restrictive territory. The other thing that's going to happen, we are already, this economy is sort of on the verge, on the brink, and as rates rise across the board, there's going to be more slowness and potential for a recession. So the markets will have to price that in, and that means the EPS downgrades are likely still to come. So even if we get some sort of a pop because of a so-called Fed pivot, the reality is the relative value of equities is quite challenged when rates are close to 4%.
Well, we're getting a drop now on the S&P. We're down by a little more than 1%. Yields are higher at the front end through much of this morning on a 2-year, on a 10-year off the back of that payrolls report. On twos are up 4 basis points to about 430. Anastasia, Mike Collins, going to stick with us, I'm pleased to say. Coming up in the morning calls and later, The View from the White House. We'll catch up with US Labour Secretary Marty Walsh responding to the Labour report. Looking forward to doing that with him in just a moment. That conversation just around the corner.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Equities down, yields up about 5 minutes away from the opening bell. Post-payrolls, equities down a little more than 1%. Yields higher by 4 basis points on a 2-year, just south of 430. That's the price action. Here's your morning calls. First up, RBC downgrading Lyft to sector perform, slashing its price target nearly in half due to competitive and structural headwinds. They're downgrading Norfolk Southern to neutral, highlighting potential downside given the weakening macroeconomy. And finally, KBW upgrading Goldman Sachs to outperform, expecting shares to move higher after earnings later this month. Coming up, it's the opening bell. Much more with Anastasia Amoroso and Mike Collins, plus a conversation with US Labour Secretary Marty Walsh. That conversation still ahead. Equity futures down by 42 on the S&P. We're negative a little more than 1 full percentage point. Yields higher through the curve on a 10-year, up 7 to about 389. Your opening bell up next.
Most of us don't spend much time thinking about the grid. the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
25 seconds away from the open about this morning. Good morning. Up on the week through Thursday's close by a little more than 4% on the S&P. Futures coming back in this Friday morning. We're down by a little more than 1%. Post payrolls, the Nasdaq 100 is down about 1.7%. The Russell of small caps down by about 1%. The winners this week, all about energy. The energy names on the S&P up around 15 percentage points. Switch to the board and get to the bond market. Yields look a little something like this, up 6 or 7 basis points, 388.95 on a 10-year. Yields up at the front end as well. In the commodity market, we had some more weight to this crude rally through Thursday, up around 12%, up another 1 percentage point this morning. 89.33, had a little look at 90 earlier in the session on WTI crude. Dollar strength out there, euro dollar negative 0.25%, 97.67 on euro dollar. What are we, about 25 seconds into this? Let's get you some movers. Here's Abby.
Given the solid jobs report, John, we of course have the familiar story, as you've been talking about all morning, yields up, stocks down. So let's keep it macro. One of the big drags, of course, Apple down 2%, yields higher, mean technologies down even more than other stocks. Valuation really comes into concern. JP Morgan Chase, the banks lower even with yields higher, and as the yield curve inverts less, that would typically help out banks, but that's really not the case. One of the conundrums of this year. We do have a little bit of a bid for the energy sector. In fact, it's the only sector higher at this time, with oil up 1%, as you were just mentioning. And then, of course, there's AMD. They missed sales by $1 billion. There's this sign of a PC slump. This stock, John, is now down more than 50% this year. And, of course, Morgan Stanley is warning that it could, in fact, even get worse.
Abby, thank you. Picking up on the energy story, the outperformance of energy relative to information technology. Story of the session, story of the year as well. Energy up by about 0.4%. Information technology, that group on the S&P, down almost 2.4%. A strong labour report, a weak set of chip maker results. Not a good recipe for big tech. Ed Ludlow has more. Hey, Ed.
Good morning, John. It's not pretty on the Philadelphia Semiconductor Index, down 3.4%, biggest drop in around 3 weeks. As Abby said, AMD prelim sales for the third quarter missing projections by $1 billion. We also had Samsung overnight as well. The first profit drop since 2019. There's momentum in the bad news for this sector, and all we're getting is evidence that it's not just a slowdown in the PC market, but for memory chips as well. We could be facing a pretty protracted slowdown in that sector. Also, of course, the jobs numbers hitting big tech pretty hard, looking at the Nasdaq 100 down 2%, and some of the mega caps also feeling the pain. It's not just this idea that higher rates discount the present value of future profits. I think there is mixed opinion on the street about how big tech, including higher multiple chip names, fare in a recessionary environment. It's not just about whether they have strong cash flow, it's also about the sort of breadth and diversity of their business. New versus old Dow theory. I think I heard you talking to Taylor about this the other day. It's this idea that chips are the new transports, right? Everything uses chips. So if chips are suffering, that's kind of a leading indicator in the way that rail freight used to. But I'm keeping an eye on this space. The signs have been there for a little while, and it could be a pretty ugly session in the semiconductors.
Taylor's the only one that can talk about the Dow on the show.
I apologize.
Let the rules out. It's all right. It's all right.
love being the favorite.
Taylor Riggs made those rules up herself. Taylor Riggs, let's talk about the winners this week. It's all about energy.
The favorite children always get a pass. I'll leave that alone, John. Take a look at where we are with the energy sector. And I think what's really interesting, we were speaking with Jonathan Golub over at Credit Suisse yesterday and saying that if you've tech to the downside and energy to the upside, that is sort of the downside and the upside risk around the volatility of this quarterly earnings season. You take those out and things actually look stable. But energy, of course, does present sort of that upside risk. When you think about the huge rebound in crude again, looking at $98 a barrel. A few days ago, ExxonMobil had climbed 4%. That was at a 5-week high. Chevron is near an all-time high. So the good news, at least for the energy companies, keep continuing to come as we think about day 2, day 3 reaction to the OPEC plus production cuts, of course, that are underway. Of course, this is a big weekly gain that we see here, some of the biggest weekly gains that we haven't seen since March. Again, seeing that follow through from crude prices back into the energy stocks as well, because there hasn't always been that one-for-one correlation as well. Let's talk about the energy companies, though, John, as we're thinking about sort of the earnings season that's coming underway. As you can see, things actually don't look horrible. You're not looking at some massive declines here, at least when we think about the volatility around these companies, maybe shaping up to be another decent report, at least on a relative basis to some of the other sectors.
Hey, Taylor, thank you. Earnings season just around the corner, 1 week away. JP Morgan, October 14th, 7 a.m. in the morning. Kelly Lyons joins us now for more. Hey, Kaylee.
Hey, John, I can't believe we're already here again. And I would just like to remind our audience what happened in the aftermath of JP Morgan kicking off earnings season last time around. And that was actually a pretty healthy rally. From mid-June until mid-August is when we saw that 17% gain in the S&P 500 before we started worrying again about the macro policy picture and everything started to deteriorate. But the message of last earnings season, by and large, was it could have been worse. It wasn't as bad as feared. The question is whether that is going to hold true this time around, because we have seen expectations deteriorating the closer we get to this season. Looking at the Citi Earnings Revision Index, we see that downgrades are outpacing upgrades for 17 weeks in a row. That is what we see here on this chart. And if you listen to some of the bears on the street, that has further to go. Mike Wilson of Morgan Stanley has been pounding the table about this for some time now. The idea that we have not yet seen the bulk of earnings revisions, that we're still too optimistic given the economic outlook and the margin pressure a lot of these companies could be facing. So buckle up, everyone. It's not just about the results, but about the guidance as well. And as I said, and you said, it begins with the banks next week. Only $1.8 trillion worth of market cap will be reporting next week. It's really October 24th. That's the big one when we get all the big tech players, the Alphabets and Apples of the world. $15.3 trillion of market cap will come that time around. And of course, for a lot of those big tech companies, other big multinationals as well, there is huge overseas exposure. And so FX headwinds going to be a big theme this quarter too, John.
Kelly, thank you. That's your setup for earnings season. Back with us, I'm pleased to say, Anastasia Amoroso, Mike Collins. Anastasia, this is your theme, and I think it's an important one. Just because we see strength in the labor market doesn't mean there's no weakness elsewhere.
No, there's plenty of weakness elsewhere, and there's a lot to pick up on here in the discussion that we just had about semiconductors and energy and banks. And for semiconductors in particular, I mean, a secular grower as this industry is, it is definitely not immune from cyclical headwinds. And I think the weakness in semis have started with the PC market, and we don't need as many laptops and computers as we did during the pandemic. But I think that weakness is going to spread to other places. And for sure, we're likely to see slower spending on hyperscaler CapEx, for example, and that's going to negatively impact potentially the semiconductor trade. And then eventually, I think the auto market weakness is likely to come to fruition too. So I just think semiconductors is a tough place right now, and it is really showcasing the slowdown that we see in the economy. So that's one thing I wanted to comment on. And then speaking of other places where we might see weakness is the banking sector. And full disclosure, I've liked this space for the soft landing scenario, but we have to kind of pivot away from the soft landing scenario given what the Fed is doing. And so one concern that I'll be watching for in this earnings season is what happens with delinquency rates, what happens with net charge-offs, are there any red flags that the banks are already seeing now, and most importantly, are they going to be provisioning for it? So my sense is most banks are likely to take a cautious approach, and instead of being a tailwind, which was this release of loan loss reserves, it's going to become a headwind because the banks will want to prepare for not a soft landing, but eventually a recessionary scenario. So those are the red flags. And energy, John, is a trade that we've liked all year and continue to want to buy on the pullbacks. And that view certainly has not changed.
Let me just unpick the bank story. That's from the equity side. Mike Collins, I get a feeling you actually like it from the fixed income side of things. Mike, why is that?
Yeah, there are a lot of sectors we like on the fixed income side, Jonathan, because again, if you look at the underlying fundamentals in the debt markets from a credit risk perspective, yeah, default rate expectations are going up, earnings expectations are coming down, margins are getting compressed. But are we going to have a big increase in defaults? Are the big banks going to default on their debt? Unequivocally, no, right? And are they, providing really attractive yields? Absolutely, yes. So there's a lot of fundamental value across different sectors. You look not only the banks, but Anastasia talked about the commodity space, the energy space, even the home builders, which are reporting pretty dire results recently in terms of cancellations. The auto companies are going through a cyclical weaker period, but fundamentally, they're actually in really good shape. So when the cyclical credit sectors are in good shape, that means default rates will not spike. That means high yield spreads where they are and investment grade spreads are probably close to fair value here.
Part of the problem here, Mike, is you guys. You won't buy that debt. They've underwritten some deals and they can't spin off that debt at the yields that they thought they could maybe 6 months ago, 12 months ago, Mike Collins. Is it a buyer's market finally in fixed income?
On the rate side, it is, right? When that 10-year note gets close to 4%, where it's approaching today, I mean, the markets are pricing in, Jonathan, a funds rate of 4 5/8 by next summer. That's another 150 basis points of rate hikes and not a lot of cuts going out for 10 years. The funds rate that's priced in over the next 10 years is still close to 3.5, right? So I think it's a buy on the rate side. On the credit side, we are being a little more cautious. I think the credit markets are fair value. They're not cheap. I think there's a good probability they get cheaper, and we would be buying on that weakness.
The last time we caught up, last payroll's Friday, I think you said buy the 20-year. You like the 20-year. And Mike, the 20-year yield has climbed since then by a decent 30 basis points or so. Why was it that maturity on the curve, Mike, that gets your interest?
I think the whole rate structure, basically twos and out are cheap right now. I mean, I think all these yields, Jonathan, are going to be 100 basis points lower in the next year or two. All right, that's a lot of capital appreciation on top of pretty high yields. The reason we like the 20-year is because it jumps out at you relative to the 10 and 30-year, and it's just as abnormally cheap security on the curve, and there's a lot of embedded alpha in that part of the curve.
So I imagine you're expecting a break of the positive correlation we've seen between risk and the bond market. Anastasia, are you looking for the same thing to develop? And I wonder from your perspective why that would develop.
Yeah, John, I think the fixed income markets are a lot more attractively priced than they were in the beginning of the year. And I would argue that they're more attractively priced than equities right now. I mean, I really kind of agree with Mike, for example, on the bank trade, is that while equities may not be the most interesting place to be in banks, if you look at what you can get in the fixed income part of it, I think it's absolutely spot on. And again, to pick up on the capital ratios and the kind of the resiliency of the banking sector, the capital ratios are double what they were during the financial crisis. So this is not a solvency sort of risk. So as the spreads widen out, you get much better opportunities in fixed income. And look, John, the big theme for me this year has been get paid while you wait out this volatility. It looks like we're going to be doing a lot more waiting. So if I can get a little bit of high yield in the portfolio, if I can pair that with municipal bonds, for example, that are screening really attractively right now for investors, I think that's where a lot of focus will lie.
What I hear from Mike is Mike's got a decent idea of the destination here, Mike, and I don't. You think we can be 100 basis points south of where we are within the next 12 months. Mike, does that mean you think we're going back to where we were a couple of years ago?
No, I think the zero, that zero lower bound Fed funds rate is probably out of the picture for a few more years. We've always thought the range on the funds rate, Jonathan, for the rest of our lives will probably be 0 to 3, and we're here. So maybe the right range is 0 to 4 or 0 to 4.5. Maybe it averages 2 over the next 10 years, the funds rate. But what's priced in, like I said, is something closer to 3.5 on average for 10 years. And I still think that's way too high over the long term. If you buy now and close your eyes or go to sleep for 3 years, I think you're going to have really big returns in fixed income.
Anastasia, what do you think we go back to? What does leadership look like? What's the destination in your mind? Where does this all land?
Yeah, I mean, we clearly need to work through the Fed restrictive policy stance. We need to work through the slowdown in the economy. But at the end of the day, I would still come back to some of his secular growth stories. And no, they're not going to be the leadership for the next probably few months, and maybe it's a year if it takes that long to kind of work through this restrictive stance. But if you look back and if you take a step back, what are the stocks that outperform the market over a long term? The most important thing is earnings growth. And if I think about where that earnings growth is going to lie, I mean, maybe some of it is going to come from the S&P, but, it's 7 to 9% on average is what the earnings growth for the S&P should be. Can I potentially outperform by going back to parts of tech, by going back to parts of healthcare and biotech and sustainability type trades? I think yes. The caveat to that is the big, huge tailwind for some of these tech names over the last number of years has been the zero interest rate policy. The multiple expansion has been a huge driver of returns. So I don't expect to see those outsized returns in the future. But if these companies can grow at 20, 30% per year, I think all things equal over the long run, they should still outperform the market and lead it.
Anastasia Amoroso, Mike Collins, the two of you, just absolutely brilliant. To Anastasia's final point there, zero rates, what did everyone chase? Long duration assets. No investment into things like commodities, basic resources. We weren't digging holes in the ground. We weren't building refiners. What are we seeing play out right now? This is what Jeff Curry of Goldman had to say. Revenge of the old economy. Energy up. That's the one big winner this morning, up by about 0.6% on the S&P. The underlying commodity up by 1.7% on WTI, 89.96. Had a look twice now at $90 on WTI. Brent crude, 95.93, up by 1.6%. Some breaking news just moments ago. Abby's got that. Hey, Abby.
Hey, John. Yes, we do have breaking news. CVS is said to be in exclusive talks to acquire Cano Health. Now, Cano Health, of course, operates primary care facilities and supports medical practices. So if this were to happen, this would be a continuation of their expansion, their diversification from retail. CVS, as you can see, plunging down more than 7% on pace for its worst day since November. This deal is not a done deal, John. And of course, Cano Health is backed by billionaire Barry Sternlicht. There's no certainty because Humana has a right of first refusal should Cano find a buyer under an agreement they made back in 2019. But right now, CVS investors not liking that. That stock down 7%. Cano Health has been halted.
Abby, thank you. Coming up on this program, the payrolls report, keeping the pressure on the Fed.
It's going to keep the Fed on track for a 75 basis point move at the next meeting. They were hoping that they'd still see a little bit more uptick in labor force participation, but they didn't get that.
The White House reaction, up next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine, and in the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
From New York City, about 20 minutes into the session, equity shaping up as follows on the S&P 500 with negative 1.8%, the Nasdaq down by 2.36%. The gains in the S&P 500 through today and much of this week, just one pocket of the market, all about energy. Crude higher, up 2% on WTI, $90.24 on Brent crude, $96 at around about 20 cents off the back of the payrolls report in America. Joining us now on Bloomberg TV and radio, I'm Jonathan Ferro. We're joined now by U.S. Labor Secretary Marty Walsh. Secretary Walsh, fantastic to catch up with you, sir. A robust labour market report. Rick Reeder of BlackRock called it solid. Here's my question for you, sir. You're more worried about people losing their jobs or getting down inflation?
I think we need to work on, we're worried about both, obviously. I don't want people to lose their job, but we need to continue to bring down the inflationary pressures that people have. Certainly, what OPEC made a decision on this week to do was not helpful to us. The president was disappointed. We're disappointed as administration, but we need to continue to bring down those pressures. I mean, I think that, I had a long conversation in my office today. I certainly don't want to see the unemployment number go up. I like to see people working.
That's what the Fed is forecasting. Some people say that's the objective. How are you preparing for the pain that they're forecasting? And what can we do on the supply side when it comes to things like immigration?
Well, on the unemployment, we were talking for the last 3 months about seeing those numbers go down. And in the year 2022, we've had about 440,000 jobs per month. We're still seeing 263,000 people going to work today. This month, I should say, last month, we're still seeing those numbers going on. So I think that that's something that is important that we continue to put those gains. We still have job openings. People are still looking for work. Obviously, we'd like to see the participation rate a little higher. I mean, that number went down a little bit this month. I think 0.1%. So we have to see what's happening there.
Clearly, the employee over the last couple of years is getting some leverage it hasn't had for a few years, a number of years, maybe even decades over their employers. You brokered a deal with unions in the last few months with freight rail companies, the 12 unions. I understand 4 of them have ratified the deal, Marty. Secretary Walsh, are you worried about the other 8?
No, I'm not. I mean, they're out there explaining, when I say they, the union leadership now and the bargaining committees are out there explaining to the members what's in those contracts. It was a very painful negotiation, not what I had, but leading up to me. 2 years of negotiation with really no movement. And I think that there's explaining to do in these contracts. And I look at these contracts, they're good. They're a good contract. I mean, it's 24% over 5 years. Healthcare freeze cap, work rules change. It was a good contract for the employer and employee as well. So hopefully we can get the rest of these ratified in the next 6 weeks.
In the Rose Garden, the president said this: because of this labor agreement, those rail workers will get better pay, a 24% wage increase over the next 5 years, improved working conditions, peace of mind around their healthcare by capping the cost that workers will have to pay. Have the port workers on the West Coast, Secretary Walsh, asked for the same conditions?
No, I mean, I don't know. I didn't get it. I don't know what they're asking for wages and benefits, but certainly those are all the conversations that are generally on the table. A little different negotiation. The West Coast port negotiation is a very fluid conversation. That both sides are at the table. They're both having conversations. It's a longer process than I anticipated, but that's just historically the way they've operated. They kind of take one segment at a time. I stay in close contact with both the employer side in the unions on the West Coast port, and both sides have expressed to me that they're still moving forward. There'll obviously be sticky issues that'll pop up every now and then, but nothing that's making me be concerned that I have to have a 20-hour meeting in my office about.
What would make you concerned? Because you've seemed pretty relaxed about that over the last few months and through much of the summer.
I mean, I think if I heard one side or the other side just kind of saying that they're not moving forward enough or quick enough, and there's really concern, I'd see in their voice or hear in their voice, so they'd express to me. I've spent, before this negotiation started, I spent a lot of time out on the West Coast, both sitting down with the unions and sitting down with the employers. So in this case, I have a lot better relationship with the employers and the unions than I did in the rail. The rail was kind of all new to me. The union side, I knew who they were, but I really didn't know the leaders of the unions, and I certainly didn't know the rail companies because I wasn't familiar with them in my old job. But so having that relationship with both sides going in makes it a lot easier to navigate and try and help continue to move along.
Secretary Walsh, if my memory serves me correct, I think the last time we did this on the West Coast was maybe 2014, and you can correct me if I'm wrong, but I'm just wondering, in previous experience, did it take this long?
Yeah, it did. It took longer, actually, and that's why I was having a conversation the other day, and I asked how long. It actually took longer. I think 2014. I want to say 28. I think it might have been a lockout in 28, and there was a strike in 1972. I think it was. So it does take a long time because it's very complicated. They're doing the whole port, all of the West Coast negotiation, and every pier has a different set of rules and negotiations that they have to do as well. So it's a master contract, but then there's individual rules in each of the ports. So they're going through all this systematically.
Secretary Walsh, big month coming up. Looking forward to catching up with you. Our next conversation will be sandwiched in between, I think, a Federal Reserve decision and the midterm. Secretary Walsh, thank you. The Labour Secretary, Marty Walsh, there, down in Washington, D.C. Equities down about 1.9% on the S&P, and the Nasdaq down by 2.5%. I'm pleased to say Mike McKee's dropped by the studio just for final thoughts as we look forward to next week. Mike, it doesn't matter what we say about today. This whole conversation gets hijacked by CPI next week, doesn't it?
It absolutely does. Although I think going into CPI, we've pretty much decided that the Fed's going to do 75 basis points on November 2nd, so that may not have a major impact either. The impact on the markets today is the idea that the unemployment rate went down, and so the Fed has a lot more work to do. It is a bit of a conundrum because the labor force shrank, but the real change was the number of people who lost jobs compared to got jobs. In the household survey, employment was 204,000 strong, unemployment down 261. So you've got almost a 500,000 jobs swing between the two things, and that's why unemployment is falling. The good news for the Fed, and maybe the markets are just kind of overlooking this, is that we are seeing participation drop, we're seeing unemployment drop, but we're also seeing average hourly earnings drop. They've sort of stabilized on a month-over-month basis, and that's brought them down on a year-over-year basis, and that would be good news for the Fed. And so maybe we should see things start to change in the markets.
It's good news, bad news. Mike, I've confused myself all week.
We're all confused.
We're all confused.
We're all confused.
Mike McKee, thank you. The Fed speakers say they're not confused, and maybe we should take them at their word, or perhaps not. Mike McKee's going to lead you through the inflation coverage through next week. Looking forward to that. Your trading diary shaping up as follows. New York Fed President John Williams kicking off today's Fed speak at the top of the hour with Kashgari and Bostic on deck. President Biden speaking on the economy at 1:35 Eastern Time. Looking ahead to next week, Evans and Brainerd on Monday, FOMC minutes on Wednesday, CPI and initial jobless claims on Thursday. Real yield back again this afternoon. We'll catch up with Gargi Chowdhury, Charles Schwab's, Kathy Jones, and Krishna Mamani. Looking forward to that from New York. Thank you for choosing Bloomberg TV. This is Bloomberg.
Go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in five stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it.
Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen who was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at